To deliver brief information on these topics, we have with us Mr. Prashad Dalwai Ganpati, who has over 20 years of rich research experience spanning economics, financial markets, commodity markets, energy and power sector, etc. Mr. Prashad did Masters in Economics and the Business Administration, worked as Head of Research at BSE, Bombay Stock Exchange, one of the India's leading exchange groups. Prior to this, Mr. Prashad was Head of Research in Product Development Department at Borj Africa Limited, a multi-asset class exchange based at Mauritius. Mr. Prashad played a pivotal role in the growth and development of commodity futures market in India. Sir was involved in various capacity building programs related to commodity and financial derivatives markets to impart greater awareness among stakeholders in India and Africa. Many of his articles got published in various domestic and global publications. I warmly welcome you, sir, to this technical session too. Over to you, sir. Thank you.
Yeah, thank you so much, Shraddha ji, and good afternoon to all of you. As Shraddha ji has told, my topics for today will be the contract design in the case of agriculture commodities, and later, we will be discussing about the trading and surveillance in the case of agriculture commodities. So just give me a minute. I'm just sharing my screen so that I can share my presentation. Ma'am, could you able to see the presentation?
No, sir, not your presentation, sir. Your screen is visible there, like your computer screen.
Just
like. So now it's visible.
Now it's visible. Okay, thank you.
Yeah, sir. Yeah.
Yeah, thanks. Before we get on to the session, that is designing the contract in the case of agriculture commodities, let us have a quick discussion on the background. We all know some of the salient features of agriculture commodities. Agriculture commodities plays a pivotal role in the case of Indian economy, and it almost contribute almost close to 12 to 15% of GDP. Apart from that, when it comes to the contract design part, there is a lot of economical cost that is involved, because the exchanges has to do a lot of prior research work, and then they have to incur a lot of resources in terms of getting the approvals from the regulator, that is SEBI in the case of commodity derivatives market in India. And apart from that, even the regulator also see from different perspectives in terms of the trust that the stakeholders have on the commodity derivatives market, and also on the various market intermediaries. So considering all these things, we all understand that there is a lot of significance that has to go in terms of designing a contract. So with this background, I'll just quickly take you through what is the contract design in the case of derivatives, commodity derivatives, and especially in the case of agriculture commodity markets, agriculture commodities, and what are the perspectives that we have to keep it in mind while designing the contract, and what are the various compliances that the the exchange has to follow while designing the contract. The session outline I'll quickly take you through the essential components of a commodity futures contract and the principles that we have to keep it in mind while designing the contract design, and some of the key parameters that need to be considered while designing a contract. And apart from that, I mean, we will also be discussing in brief, I mean, the product suitability analysis, basically to ensure, I mean, the contract is a success. And apart from that, I mean, the various compliances. I mean, in case, I mean, the contract is discontinued, or in case, I mean, there is a need for approval in the case of a new contract, or in case of, I mean, relaunch of a contract. So what are the, I mean, compliances that the exchange has to meet? So we will see all those, I mean, details in a brief. And then finally, I mean, the role of, I mean, various committees, uh, be it, I mean, independent oversight committees, I mean, for product design, like what are the committees that, I mean, will oversee the contract design process, and what is the kind of role they play while designing the contract, and what is the compliances, I mean, that they outline, I mean, while designing the contract. So in the case of commodity derivatives market in India, we have commodity futures, and we have, I mean, commodity options on futures contract. And we also have, I mean, option contracts on commodities. That is basically the spot contracts. So these are the three types of, I mean, commodity contracts, I mean, derivative contracts that is available in the case of, I mean, commodity derivatives market in India. So while designing, I mean, contract design for all these type of, I mean, contracts, I mean, be it, I mean, futures contract, or be it, I mean, options contract, basically we have to keep it in mind the four perspectives. I mean, like while designing the contract, one is, I mean, we have to keep hedges perspective in mind. The other one is, I mean, the regulator perspective in mind. And apart from that, I mean, we have to also keep market perspective in mind and competition perspective in mind. In the case of hedges perspective, basically while designing the contract, we have to ensure that there is a efficient price discovery process that happens because of the contract. If the contract designing is not, I mean, efficient, then it may not, I mean, lead to efficient price discovery. For instance, uh, suppose, I mean, a contract is there where, I mean, the tick size is beyond what the market norms are. Suppose the tick size in the market for, say, I mean, one bale of cotton is, I mean, some 100 rupees, hypothetical example. Then if the tick size, I mean, at the exchange where the contract design indicates, I mean, as a 500 or 1,000, then obviously, I mean, the price that is going to be discovered on the exchange platform is not going to be an efficient path. So while designing the contract, we have to ensure the contract is designed in such a way that efficient price discovery takes place. And apart from that, I mean, we have to see in terms of, I mean, the risk management. Basically, in the case of agriculture commodities, where there is obviously there is a possibility of greater, I mean, price volatility because of the inherent, I mean, futures. I mean, because of, simply put, it is the basically the inelastic demand or inelastic supply, which are the ones, I mean, which is going to have an influence. Since because of this inelasticity of demand and supply, there is a possibility of, I mean, prices, I mean, moving adversely, I mean, in any direction. Either if there is a glut in supply, it might drop, or if there is a drop in supply, but demand being inelastic, I mean, there is a possibility of prices going up. Since considering the possibility of greater level of, I mean, price volatility, so we have to see to what extent, I mean, this contract is going to address the risk management point of view of stakeholders, and especially in the case of hedges, because hedges are the ones who would like to hedge their risk. So we have to ensure that whether the contract is designed in such a way that it can address the hedges, I mean, perspective. And apart from that, since as I indicated before, that there is compliances which plays a vital role because of, I mean, the sensitivity of the contract design. Because contract design, not only, I mean, we have to see in terms of, I mean, the turnover, where, I mean, the exchange, I mean, would like to see, I mean, okay, higher turnover and all. But apart from that, this is also going to reflect the trust on the market mechanism. So keeping that in mind, the exchange has to ensure, the contract is designed where it meets all the compliance requirements. Be it, the various committees, or, the various other, compliances, that the SEBI has, formalized. And apart from that, from a market perspective, the contract, should ensure that the requirements of all the stakeholders are met. Be it, the participants in the value chain, could be traders, or it could be farmers, or it could be producers, or it could be processing units. So the contract design should be in such a way that it meet the requirements of stakeholders. For instance, generally in a particular market, in the case of, cotton, let's take, for example, the deliverable quantity is going to be in terms of, bales. So in that case, the design has to be in such a way where, the price has to be put in terms of, this thing, and even the delivery also has to be in terms of, bales. So in the same way, if you take, chana, desi chana. So in that case, we have to see, how, the market norms are. Whether it is, delivered in tons, or whether it is delivered in pounds, kgs and all. But in Indian context, it is going to be in terms of, tons. So obviously, we have to ensure the design part has to be in such a way where the deliverable quantity has to be as per the market requirements. So market requirements has to be kept in mind while designing the contract. Apart from, efficient price discovery, obviously, stakeholders would like to keenly participate on the exchange platform if they have trust that there is going to be an efficient price discovery that is going to happen on the exchange. If, the stakeholders were not, sure of possibility of an efficient price discovery on the exchange platform, they would, prefer, any other way of, things. Maybe it could be forward contracts, or, they would directly deal in the spot markets rather than hedging their risk on derivatives platform. And the other, final, perspective that while designing the contract we have to keep in mind is the competition perspective. So basically, in order to ensure the success of a contract, derivative contract, we have to see, whether there is any arbitrage opportunities. Is there any other exchange, which is, trading, similar sort of contract, or it could be, possibly maybe of different size. The size of the contract might vary, but otherwise, the underlying asset has to be same. So in that case, there is a greater possibility of more stakeholders, participating on this exchange to leverage on the arbitrage opportunities. And apart from that, the size of the contract, we have to keep it in mind. Like as I've given before the example, so the other exchange, suppose one exchange is trading chana, say for example, 1 ton of, the contract size is 1 ton. Then in that case, the exchange, suppose even if wants to, launch a chana futures contract, they can think of, a contract where the size could be maybe 100 kg, or it could be, of similar size of 1 kg. So basically, all these, perspectives has to be kept in mind while designing the contract to ensure a greater success of a contract. So before, we dwell in detail, the other things, we have to keep it in mind is the principles on contract design. IOSCO, which is the International Organization of Securities Commission, has prescribed certain principles, guiding principles for all the exchanges, stock exchanges. Like what all they have to keep it in mind while designing contract, so that it meets the requirements of all the stakeholders. So basically, these guiding principles will act as a kind of guideline where exchanges can come out with contract designs that is more suitable for the stakeholders. So the ISCA has indicated 6 principles for best practices in futures contract design. The first one is the economic utility. ISCA has indicated that economic utility should be kept in mind while designing contract. Obviously, if there is no economic utility, then the purpose of having a futures contract or any derivatives contract is meaningless. So we have to ensure while designing a contract that there is a proper price discovery that happens, and it also addresses, I mean, the risk management of, hedges. If there is no economic utility, obviously no hedges, or the even the regulator would be keen to approve the specific contract. So the first thing that the exchange has to keep in mind is that there has to be an economic utility for the contract. And apart from the economic utility, the correlation with cash market is also quite important. If assume there is a dichotomy where, the cash market is indicating a specific price, and whereas on the expiry date of the futures contract it indicates a different price, then and they move in different directions over a period of time when the contract is traded, obviously people who would not be keen to come on to the exchange platform to trade, because obviously there is no correlation, and because of that, the economic utility is not going to serve, and people also, will be losing trust. In the sense, they have doubts about the price discovery process on the exchange platform. So in order to address this, what needs to be done is the correlation with cash market has to be efficient, where it reflects, it should reflect, the prices of the underlying asset. So once, that happens, obviously you will find, stakeholders more keenly, coming onto the board and then taking the trade positions. Apart from, correlation, the other thing, the other key principle is the promotion of convergence. Ultimately, on the expiry date of the derivatives contract, it has to converge with the spot market. If the convergence is not going to happen, then people again, will have, will be skeptic, in terms of the price discovery process on the exchange. So always, the contract design should be in such a way where, in terms of, the settlement of the contract should be specified in such a way that the derivative contract converge with the spot market prices. And accountability is the other, key principle that needs to be kept in mind while designing contract. See, in terms of accountability, there should be a clear framework in terms of the criteria of our reviews or the procedures that is going to be followed, and the responsibilities, like what sort of, committees are going to be there and what is their role and responsibilities. All these accountability will ensure greater, confidence and trust on the contract, and that will result in, higher volumes on the platform, etc. And that are quite important while designing the contract. In case of, transparency, there should be like a proper rule book, rule changes, everything should be properly, displayed, so that, participants are, taken into confidence. So these are the things, that IOSCA has prescribed to ensure the contract design is efficient. So these are the, guidelines that exchange has to keep it in mind while working on contract designing process. We will go in deep in terms of, economic utility. In the case of economic utility, while designing the process, a contract design process, we have to keep it in mind that there is a large and active cash market. Suppose, assume the for a underlying commodity, if there is no large and active cash market, then obviously, that will have an impact on the success of the contract. For instance, if the underlying market is quite big, then there is a possibility of more number of stakeholders participating, and also greater trade numbers. If the commodity is confined to a specific geographical area, or where there is limited stakeholders, if the value chain is much shorter and there is a limited participants in the value chain, in that case also there will be a favored number of participants in the value chain. So obviously the possibility of those people participating on the exchange platform will be less. So in order to ensure the success of a contract, economic utility has to be considered. What is the size of the underlying asset? What is the size of the underlying, cash market? Is there proper price? Yeah, availability is there. Is there, any particular, markets are available, and what is the kind of prices, being discovered in those markets, or those, prices, being transparent enough, for the stakeholders in order to accordingly command the trade on the exchange platform. And in the case of, correlation with the cash market, the regulators, will have, certain things in mind while finalizing, or while approving the contracts. So the regulators has to ensure whether, the contract, reflects the size and structure of the market, whether there is a historical pattern of production, consumption, supply available. In case of, lack of this data, obviously the impact will be on the price discovery process. In case of, availability of historical patterns of production, consumption, supply data, there will be greater flow of information, which will result in efficient price discovery. Just to keep it in mind, what is the kind of, historical data or other, the market-related information of the underlying asset? Is it available or not? And other than that, they also need to keep it in mind the quality and grade of the underlying commodity. What is the kind of, quality and grades that is available in the spot market? If the derivatives market, if the contract, indicates, is different, underlying grade or quality of the underlying asset, then obviously there is going to be a mismatch, which is going to have an impact on the success of the contract. For instance, let's take, a particular length of, cotton, which is acceptable in the spot markets. Suppose in the case of, the derivative market, if the particular specification is not, in line with the market requirements, then obviously, nobody would be keen to come out to the board, because first of all, the price that is going to be discovered is not going to be in line with the spot market. That is one thing. And apart from that, even, though there is going to be a negligible, deliveries that is going to happen, even on exchanges compared to, the trading volume. In that case also, yeah, usually, it is sometimes, hardly, for most of the even most successful commodities, derivative contracts, it is going to be in the range of 1% or 2% max, even in global benchmark exchanges. So keeping that in mind, so even in that case also, people would like to, prefer, to take the delivery of the goods, that is in line with the spot market, and they won't be keen to, take delivery of some other grade or, quality of the underlying asset. So these things also has to be kept in mind, and while designing the contract. And apart from that, while working on the contract design, even, the regulators need to ensure whether the contract, accommodates, vertical integration of production and consumption of producers and merchants. If this is not going to enhance the vertical integration of the value chain, then again, that is not going to serve the economic utility. So these are some of the salient things that the regulator needs to ensure before approving a contract. And coming to the promotion of convergence plays a vital role. When we talk about, price discovery process. As we discussed before, if the convergence is not happening, then obviously the trust in the case of, commodity derivatives, of that particular contract, is going to be lost. So the while designing the commodity derivatives, we have to ensure, there is proper, convergence that is happening between the futures and the spot markets. And while working on this contract design, we have to see in terms of, the convergence process. If the convergence, has to happen, so we have to see, the regulator has to ensure, whether the delivery is physical delivery, or in the case of, certain commodities where it is cash. So they have to see whether, if it is cash settled, how the convergence is going to happen. So let's, try to understand in the case of physical delivery, how the convergence has to be. And in the case of, the cash settled contract, how the convergence, what are things that we have to keep it in mind while designing the contract. In the case of physical delivery commodities, the convergence, can be ensured by ensuring the futures contract, is in line in terms of, the size and trading unit. And also it has to be in line with the trading months. Suppose, for instance, in the case of, especially in the case of agriculture commodities, we are aware that there are, going to be seasonality, which comes into place. So since, seasonality plays a vital role, we have to ensure, the contracts, are in line with, the seasonality of that particular commodity. If suppose, the contracts are available, which are not in line with, the seasonality of that particular commodity, then obviously, the contract is not going to taste success. So we have to ensure, which are the trading months, when we launch, whether it is in line with the seasonality of that underlying asset. And apart from that, we have to ensure minimum price fluctuation. What is the tick size? Whether the tick size is in line with the tick size that is prevailing in the physical market. And in terms of quality standards, what is it, acceptable norms of quality standards for, be it, any underlying asset, be it China, what is the kind of, the grade, and what is the kind of quality that needs to be considered, in the case of, futures, so that it is in line with the, physical market. In the case of cotton also, what is the, kind of, the parameters that is, considered in the case of spot market. In futures market also, it should be in line with that. And even, be it, for cardamom also, in terms of the specifications, what should be the, the specifications, as far as quality is concerned, because it has to be again in line with the physical market requirements. So then only, it will ensure a greater success for the contract. And also we have to keep it in mind in terms of, which are the delivery points for, while indicating, the delivery points in the contract design. Since, this, for each of these underlying assets, there will be certain benchmark, spot markets. We have to ensure the delivery points are also in line with the those benchmark, spot markets. If suppose, the deliveries are going to happen in some other place, that is going to, discourage, greater participation from stakeholders. So while designing the contract, even the deliveries points has to be kept in mind while designing the contract. And apart from that, we also need to ensure, price limits. What should be the price limits? What should be the position limits? All these, play a vital role, especially in the case of agricultural commodities, which are to an extent have a greater impact on the entire, economy as such. Because compared to, non-agricultural commodities, because it might have an impact on inflation, it will have a direct impact on the consumers, and it will have a direct impact on, farmers. So keeping those things in mind, a greater, focus should be given, on price limits, like what should be the daily price limits, what should be the price range, and what should be the, position limits in case of clients. We will, discuss all those things when we discuss later the trading and surveillance session. What should be the, position limits at the client level, what should be the position limits at the member level, and what is the position limits that should be considered at the exchange level. All those, we'll discuss in detail. And in the case of, cash settle contracts, we have to keep it in mind, what is, the basis for the pricing. Is there, any reliable index, or, is there any third-party information providers who provide, authentic prices, on which, the contract can be settled on the date of expiry, or is there any agreements, the exchange is having? The regulator has to ensure, if the exchange is having a proper, agreement, price sharing agreement with other, benchmark exchanges. Suppose, for instance, an exchange in India launches, a contract, say, for example, soybean, and which is basically benchmark, to the soybean that is traded on CME that is the benchmark, exchange in US. So in that case, whether the Indian exchange is having any tie-up with the CME while sharing that price information, so that the Indian exchange can settle the contract based on the prices discovered on the CME platform. So these are the things the regulator will keep it in mind in the case of cash settled contracts. But since our focus here in this session is going to be explicitly on the agricultural commodities, where most of them are delivery based. So in fact, this plays a slightly lesser role. So far, we discussed about the guidelines, we discussed about the parameters the regulator will keep it in mind, and the perspective the exchange has to keep it in mind while designing the contract. Now look at the post-launch. What are the obligations on the part of the exchange? Basically, post-launch, the exchange has to ensure proper market surveillance, where they need to ensure what is the kind of responses. The stakeholders, and what is the kind of feedback they are providing on the contract. And apart from that, they have to ensure the exchange resources are familiar with the cash market, the product, terms and conditions, and the type of market participants who participate on the exchange platform. And also, the risk needs to be reviewed. Risk management has to be reviewed in terms of margin requirements. All these the exchange has to be familiar with in order to ensure successful operation of the contract. So basically, we have discussed before the kind of process that is involved at the exchange level, since this plays a vital role not only in terms of impacting the success of the contract. It also is going to have a direct impact on the brand image of exchange as well, and also on the various other market intermediaries that are going to play. So considering the kind of the trust that is involved, so let's try to understand what is the kind of the process that goes in the case of product development. So what are all the various stages? So is it like a straight away is it going to be launched overnight? No, obviously there is a lot of things that goes behind the screen before finally the commodity is launched. Be it futures or be it options contract, there is a lot of background work that goes for a period of time, and sometimes this could be as long as a year or a couple of years also. For example, many of these exotic commodities, it took more than a couple of years. And I was also involved in launching few of those exotic commodities before. So in fact, it happened to be like more than 2 to 3 years before we launched the final product on the exchange platform. So let's try to understand what are the various stages that is needs to be considered, that is going to be there before a product is launched, and what are the things that will be considered at each stage. So the first stage is conceptualization. So conceptualization basically happens where the exchange, the resources, they will be in regular touch with the markets. So basically what we call it as a market consultation exercise. Or there is a possibility of where the exchange resources might be directly in touch with some of the experts and might consider the expert opinions. Or it could be some internal evaluation where the exchange personnel might be find some opportunity, or the since they will be constantly interacting with the stakeholders in the commodity derivatives market. So basically they will be trying to understand what are the physical markets of each of these commodities, how they operate, what is the kind of challenges these physical markets are facing, what is the kind of level of price discovery that is happening, is it transparent enough, or if at all there is too many intermediaries, what is the kind of margins that is involved at each and every stage of the value chain. So all these will give a lot of information to the exchange personnel, who in turn, might see any opportunity where, they can address the requirements, and as a result, they might extend, services, by launching, the necessary, commodity contracts, derivative contracts. So the consultation stage, broadly, there is a three ways, where, either it can come in the form of, market consultation, where, since they will be constantly interacting, with the all the stakeholders, they can get the information, or through expert opinion or internal evaluation, they get the inputs. So once, they understand that there is a need for a particular derivative contract on XYZ, commodity, where the underlying asset is going to be XYZ commodity. Then, they move to the next stage. They will try to come out with a feasibility study, where, they will study the characteristics and salient features of that particular product, in terms of market size, in terms of that homogeneity. All these, play a vital role. We will discuss those later on in our session in detail. So basically, they try to understand what is the kind of success, that this particular commodity is carrying. So based on that, once the outcome of the feasibility study will ensure the resource exchange personnel, taking it to the next stage. The next stage is internal evaluation. Once, the research team, or the, it again, depends upon the exchange. Like some exchanges, they will have research teams working on the feasibility study. Some exchanges, they will have, the business development teams and research teams, they work together. And once, they work together, they will come out with the feasibility study. They will take it to the top management for their inputs, and also, if at all, they get the approval of the top management, then they will take it to the next stage. So once, at the internal evaluation, the top management will evaluate. They will ask for, necessary information if it is not adequate, or if they find, the feasibility study, based on the feasibility study, that this particular commodity, if the derivative contract on this underlying commodity is having huge potential, then they will, give the nod, and then it goes to the next stage, where, submission of proposal happens, with the regulator. So what exactly happens at the submission of the proposal? At the submission of proposal, here, basically, there will be a lot of, the regulator, have certain parameters, which, the exchange has to provide in terms of, data, in terms of, the inputs, description, all those. So there is, framework, so which, the exchanges are asked to follow while submitting their proposals. So once they submit a proposal, the regulator, will ensure that it is adequately discussed, in terms of, the regulator will ask the stakeholders to come participate, give their inputs, and also it will also ask the exchanges for certain clarifications, or clarifications it might ask even from the stakeholders also. So once, the regulator, get all the necessary inputs, and they are satisfied that there is a potential, there is an economic utility by launching this contract, then they will give the approval for launch. So once, the regulator, in our case, the SEBI approves it, then it goes to the next stage, where the exchanges will go ahead with a particular plan, in terms of, going and taking it to the all the stakeholders, before launch. And then they do the necessary exercises of sensitizing, the entire, stakeholders, and also the players in the ecosystem of that particular commodity. And once that has happened, they will go ahead and launch the contract. So they will conduct road shows, or any other ways of, ensuring constantly engaging all the stakeholders, and then finally they go ahead and launch. So the role of, exchange doesn't end there. Even after the launch, also they have to ensure that they keep, asking for feedback from markets. Either, through by directly interacting with all the stakeholders, or by observing the volumes, or by observing the kind of participants what they are on the platform. And in case, they find it, either through feedback from the stakeholders, or from their own internal observation that there is a need for certain changes in the contract design, then they have to accordingly make the necessary changes in the contract. And then again it has to go back to the regulator for further approvals. So in that case, again, we have certain criteria, like what is the level of changes. I'm not going to go in depth, because that will again, with the time constraints we have, so we can't discuss in detail. But basically there are certain parameters, like the regulator has indicated, like if there are peripheral changes, be it the size of the contract or some other things, peripheral things, then there are the compliances are much less. But in case there is a bigger compliance requirements, in case of significant changes in the contract, then obviously they have to take the approval of the exchange, the regulator. So some of the key parameters that play a vital role in the case of success of a contract is the standardization. If there is a possibility of standardization, obviously that will have a positive impact on the success. In the case of price control, especially in the case of agriculture commodities, this plays a vital role. If there is a constant intervention by the policymakers or by the government, then obviously it is going to have an impact on the price discovery process, right? So price control plays a significant role in the case of agricultural commodities. The moment for commodities where there is going to be significant price control, be it the cap, or be it the minimum support price, or whatever the case may be, so that is going to have on efficient price discovery process. So obviously the commodities where there is a minimal price control or no price control will see greater success. And price volatility is one of the significant parameter that needs to be considered. The greater the price volatility, the greater the success of the contract. Obviously, since there is a greater price volatility, the stakeholders will be keen to participate and hedge their risk. And the other key parameter is the large number of buyers and sellers. If the market size is small, or if the stakeholders are few in number, now obviously there will be lesser interest on the derivatives market. Because obviously there are very few players, and they may or may not be interested in participating on the exchange platforms. So the greater the number, the greater the chances of the contract being a success. And the other key parameters are the geographical coverage. And in case of geographical coverage, again, if the product is spread across the country, then obviously there is a possibility of greater number of participants on the exchange platform. The narrow the commodity, suppose the commodity is confined to a specific region or a state or a particular region, then obviously the possibility of the contract being a success is going to be minimal. And in case of global commodities, obviously the global commodities, there is a greater chance of success. Because there will be immediate global reference price available. So which in turn, will have an impact on the price discovery process in the domestic market as well. So these are some of the key parameters that we have to keep it in mind, which will help us in deciding the potential of a particular product, whether the product can be a success or a failure. So this is let's have a quick look at the sample scorecard. So these are some of the weightages for various parameters, like in the case of a specific commodity, the production numbers, the consumption numbers, whether it's a trade surplus deficit, all those are the key ones which carry a significant weightage of 10%. And as I indicated before, the price volatility and the information, that is the spot price information, all these play a vital role. And apart from that, the market participants, how keen the market participants are, in terms of participating on the exchange platform. All these decide the success of the contract. For instance, in the case of non-agricultural commodities, like for example, I happen to work on the contract design for diamonds. So the diamonds, the supplier or few number. De Beers is one of the big supplier, and apart from that, there are other couple of players. So obviously in that case, the suppliers are limited, so they are not keen to participate on the exchange platform. If that is the case, then obviously the kind of success cannot be foreseen in the case of those particular products. So these parameters we have to keep it in mind while designing the contract. And once we evaluate the parameters, we understand that there is a good chance or probability of the contract being a success, then the exchange go ahead and launch the contract. So once the contract is launched, the evaluation of performance also plays a vital role. So evaluation can be in terms of the market feedback. It could be, in terms of stakeholders participation, like what type of stakeholders are participating. Is it, only specific type of stakeholders are participating? Like only is it FPOs, or is it only the farmers are participating, or even traders are participating? Or is it only the small farmers are participating? So we need to understand, the greater, the types of, stakeholder participation, we can consider the contract as a success. And at the same time, the convergence with spot market. The convergence with spot market, it directly indicates that the contract is a success. And geographical spread and trade volume, and also the lifespan, all these the other, key parameters for evaluation. The longer the contract, obviously to an extent we can assume that the contract is a success, because any contract, if it is not able to run for a longer period of time, obviously must be having certain lackness or lack of interest from the market participants. So all these help us in evaluating the performance of product. This snapshot of the performance review of commodity derivative contract, the parameters the regulator has indicated, like they consider these parameters. So any exchange while launching the contract has to before getting the approval process, they have to provide all these parameters, and then also they have to ensure the performance review based on these lines. So this is a snapshot of the goods that is notified under SCRA. So basically, the exchange has to keep it in mind that whatever the product that they would like to launch, it has to be notified under SCRA. If it is not notified under SCRA, then obviously the exchange can't go ahead and launch the contract. So first of all, before launching the contract, they have to ensure whether that commodity is approved, notified under SCRA. Once it is notified under SCRA, then they have to go back and check the other parameters, and the feasibility study needs to be carried out to understand the success of the contract. So the regulator has indicated certain eligibility criteria. Since the launch of a contract is cumbersome exercise, and it got a lot of significance, which we have discussed at the beginning of our session, the SEBI has indicated certain eligibility criteria, so that there is a greater chance of success of a contract. One is the commodity fundamentals. Like there should be a homogeneity, standardized contract, which is going to ensure greater success for the contract. If there is a lack of homogeneity, or there is a lack of standardized contract, obviously that will result in failure of the contract. And durability and storability is the other parameter that will decide the success of the contract. If a commodity is durable in nature, then obviously there is a greater success. If it is not durable and it is a perishable in nature, then it becomes much more difficult for the contract to be a success. And ease of doing business, where we have discussed before, the price control, whether there is a lot of interventions. Then if the greater the interventions, obviously that is going to have a negative impact on the success of the contract. And the trade factors such as global availability of the product, the value chain, the geographical coverage also play a vital role in deciding the success of the contract. So obviously the regulator has indicated some of these key parameters, and also in terms of risk management. So once the stock exchanges want to launch a product, they have to ensure whether it meets all these eligibility criteria. So basically this acts as a guideline for stock exchanges to launch contracts that are going to be success. So this is the template, for the eligibility of commodity derivative products. So they have indicated, the various weights, that the exchange, would like to assign on the subscores. The greater the subscore, suppose they have given, various sub parameters under each of those major parameters, and we have to, as an exchange, before submission of the contract design, we have to indicate these are the various, parameters, and we have to give the weight. If the score is on the higher side, suppose on a scale of 10, if it is somewhere, around 7 to 8, there's a greater possibility. If it is, falling somewhere under 3 or 4 on scale of 10, then obviously the chances of the contract being a success is 4. So the scores, has to be indicated, while filing for approval of the contract. It's not like every contract that is launched on the exchange platform is going to be a success. There is a good possibility of many of these contracts, not meeting the expectations. Probable reasons could be vary depending upon the contract. Probably it could be a small, a contract where the underlying commodity has a smaller market, or the stakeholders might be fewer in number, or the contract design may not be in line with the market requirements. So in those cases, there is a good possibility of the contract not meeting, the retention criteria. So in that case, either, the regulator, as per the specifications of the regulator, the exchange has to discontinue or suspend the contract. So basically, the regulator has indicated the what are the things that has to be kept in mind as far as the exchange is concerned. In case of the contract, is discontinued, suspended, then the exchanges are not in a position to relaunch, the contract within a period of 1 year. So they have to at least wait for 1 year. In case, it fails to meet the retention criteria, so in those cases also, the exchange cannot, relaunch the contract immediately. It has to again wait for minimum of 1 year before relaunching. So these are the criteria that SEBI has indicated, so that there is not too many contracts that are launched and which result in failure. So that will have an impact on the trust factor. So we will have a quick look at the oversight committees, because they play a significant role while approving, or while designing the contract process. So one is the regulatory oversight committee. Regulatory oversight committee considers, it has the responsibility of the oversight committee is, to constantly review the product design and ensure, it meets all the compliances of the regulator. And also they have to ensure there is adequate resources being dedicated by the exchange for that particular product design. Be it, in terms of designing the contract, or be it in terms of, somebody owning the responsibility. So all these, the regulatory oversight committee will have a look at it, and it gives its, feedback. And apart from the regulatory committee, there is the product advisory committee, which is, in brief, popularly called as PAC, which plays a significant role. So PAC, basically, it role is like ensuring, the design process, reviewing the product design process. And if at all, in future, because of either, feedback from market, if there are any changes, in the product design, then again, it has to be run through the product advisory committee, which will again relook into it, and it periodically, takes the feedback from the stakeholders. If there are any comments from stakeholders, that has to be, reviewed by the product advisory committee, and accordingly, it will, guide, or it will give suggestions, to the exchange while, designing the contract. So product advisory committee and the regulatory committee play a vital role as far as, guiding the exchanges in terms of coming out with a appropriate product design. This is a snapshot of the MCX cotton futures. Since we are running out of time, so I'm not in a position to, discuss all this, but basically, this snapshot, indicates the salient features of a contract. Like in the case of cotton futures, it has to be the significant things are like the trading unit. It has to be indicated like as per the market norms. It is in bales. And the other important thing is, the price quotation and how it is quoted. It is quoted in rupees per bale. And in the case of price quotation, which market? They have to consider the benchmark. Market for cotton. So the benchmark, if by any chance, the price quote is not as in line with the benchmark spot market, obviously then there is a lesser chance of the contract being a success. And also the other things are, the order sizes has to be in line with the market requirement. If the market prefers a particular size, then that has to be in line. The product design team has to ensure that is in line with the market requirement. And the tick size, in the case of cotton, it is 10. So basically this all happen in consultation with the market, where they take the feedback like in spot market, what is the kind of price movement that happens in the spot market, and accordingly by designing the futures contract or derivatives contract, they have to consider those inputs. And the price limit and those things basically that has to be kept in mind in keeping the compliance requirements of the regulator, be it the initial margin, be it the extreme loss margins. We have to keep it in mind. What is the regulator's compliance requirements, and as per the requirements, the designing process has to be carried out. And in the case of this quality specification, we have to ensure that is in line with the market requirement. Like in the case of cotton here, it is like what sort of grade or what sort of coloration, what is the length, all this has to be in line with the market requirement. So quality specification also plays a vital role. So if you have a look at the snapshot, you can understand the kind of details that's been provided basically. So this indicates the kind of significance the quality specification plays a role. And this is a snapshot of the Chana futures. So again here, all these unit trading, delivery unit, the delivery centers, all this play a vital role. And at the same time, and even additional delivery centers, you can see on top of the this particular slide, Akola, Jaipur, and Indore. So basically, while designing the contract, we have to consider some of the benchmark spot markets. So apart from the one significant this thing, we have to consider other possible alternative delivery centers to ensure the greater acceptability among stakeholders. So this is the Chana quality specification in detail. So in same way, in the case of options also, in the case of agriculture commodities, we have certain criteria like eligibility criteria. Like in the case of agri, the turnover has to be around 200 crores per year. And in the case of non-agri, it has to be 1,000 crores per year. Based on this, then particular commodity qualifies, whether there can be a derivative contract on it. And in the case of options, in the case of options on spot, we have the exercise style is European style, and in the case of the futures, we have both styles. So basically, these are the things we have to keep it in mind, like what is the SEBI guidelines as far as launch of options. So based on that, while designing the contract, we have to appropriately design in terms of what should be the settlement methodology, in terms of exercises, how it has to be done, and if it is a strikes, what is the number of strikes that is allowed. In the case of ITM, whether it's 3 or whether it's 1, whatever it is. So in the case of SEBI, they have explicitly indicated that in the case of ITM, there are 3 strikes that is allowed, and in the case of ATM, there is 1 strike that is allowed. So all these things has to be kept in mind while designing the contract. So these are some of the useful references. So thanks for your time, and if you have any specific queries, as far as product design is concerned, please feel free to ask.
Thank you, sir. Sir, we will have questions and queries after the second session, like second lecture.
Fine, fine.
So you will, yes, sir. We will continue.
Yeah. Can we have a 2-minute break and then we will start with the.
Okay, sir. Yes, sir. No problem.
Yeah. Thank you.
Okay. Dear participants, please be online. We will start within 2 minutes. Okay. Thank you. And for participants, please put all your questions in the chat box. We will ask all your questions to the experts after the completion of this session. Thank you.
Hello. Hello, ma'am.
Yes,
Am I
sir.
audible?
Yes, sir. Yes, sir. You continue.
Shall we go ahead with the next session?
Yes, sir.
Yeah. Thank you. So far we have discussed about the product design process, how the designing part happens, what is the kind of stages that it goes through, and what are the key parameters that we have to keep it in mind, especially in the case of agriculture commodities. Now in this session, we will try to understand what is the trading process. What is the trading and surveillance things that we have to keep it in mind as far as agricultural commodities are concerned. What are the different types of orders, and what are the different entire process, how the trading process happens, and then the kind of orders that is left out with. So let's start with the session outline. The session outline, I will be quickly taking you through the types of orders, how the order management is going to happen. If at all, there is any modifications in the orders, what is the kind of modifications that can be carried out, and so in what cases, I mean, there is no possibility of any modifications being carried out, and surveillance, how it is going to be done at the exchange level, and in the case of, I mean, the margins, what is the kinds of, I mean, margins that are there, and in the case of, I mean, position limits, what are the, I mean, compliances, I mean, the regulator has indicated in terms of guidelines. What is the position limits at the member level? What is the position limits at the client level? And at the exchange level, what should be the position limits? And what is the policies as far as, I mean, surveillance is concerned? Essentially, I want to convey, I mean, as far as operational procedure of a commodity exchange is concerned, the three key things are, I mean, trading, clearing, and settlement. These are the three stages that play a vital role. So in this session, I mean, we'll be focusing on the trading part, and in the subsequent sessions, I mean, the rest of the market experts will talk about, I mean, the clearing and settlement process. So in the case of trading mechanism, let's try to understand what are the, I mean, trading mechanisms that is available. So in the case of trading mechanism, we have to understand what is the trading futures. So what are the kind of futures that is available? What type of orders we can put? What sort of, I mean, the other, I mean, futures, what sort of modifications that can be carried out? And what is the trading workstation? How this framework works? So we can have a quick look at the trading workstation. What is the role of, I mean, the entire landscape, I mean, as far as, I mean, this trading mechanism is concerned, and then the type of orders and how the orders, I mean, are validated, how it is matched, and even if at all, I mean, it has to be changed or managed, I mean, how it is going to be done, and how close price is derived, what is bow coffee. All these, I mean, are going to be discussed under trading mechanism. So coming back to the trading futures, currently, post, I mean, launch of this national level commodity exchanges, I mean, be it, I mean, MCX, be it, I mean, NCDX, and NMCE in 2003. So in order to, I mean, promote and ensure greater success, they have allowed, I mean, only automated screen-based trading. So earlier, I mean, prior to the advent of this national level commodity exchanges, there used to be regional exchanges, and it used to be most of the cases, I mean, pit trading, where, I mean, the people shout, and there will be a floor, I mean, floor trading or pit trading depends upon, I mean, the exchanges. Like, for instance, I mean, UK and in America and all US, they have a different kind of structure where, I mean, there is a kind of physically, it is a pit form where people stand at different platform levels and then they shout. So it all happens inside a pit kind of form. Whereas in our case, I mean, in the case of India, I mean, we have, I mean, floats, I mean, meant for, I mean, different commodities. So where people assemble and then they shout at pitch of their voice to ensure greater attention. So since, I mean, there are so many limitations, lack of transparencies and all these things, with the advent of, I mean, digitalization, see, the regulator has ensured, I mean, launch of this automated screen-based trading. So post, I mean, launch of this national level exchange, I mean, these automated screen-based futures, or, I mean, like it ensures, I mean, order-driven trading system. It ensures, I mean, greater transparency, and also it ensures anonymous trading. That is, I mean, the trader's name or undisclosed. If suppose, I mean, there is a disclosure of, I mean, trader's identity, then obviously that will have a negative impact, because there is a very possibility of manipulation happening while trading. Because obviously, if there is a big supplier or big producer, or, I mean, there is a big consumer who is actively participating, then obviously that gives a kind of cue for rest of the participants in order to exploit the situation. So in order to avoid that, I mean, there is a facility in the software, I mean, there is anonymous trading, where, I mean, only the orders have been matches without any disclosure of the identity of the trader. And apart from that, there is also, I mean, the turnover, limits. What is the kind of, turnover for the buyers and sellers. So apart from that, there is the futures trading futures also gives that flexibility in terms of, placing orders. In terms of quantity, in terms of price, or in terms of, modification, and also in terms of, access to certain online information. So all this, trading futures ensures the participants basically are adequately equipped so that there is a efficient price discovery happens on the platform. And also, the trading futures also have that square off facility. So whenever somebody wants to exit the market, also there is the square off facility mode that is available. So all this ensures there is a greater attraction towards exchange based trading compared to the earlier prevailing norms. This is a graphical illustration how the entire mechanism happens. Towards your left side, see where the different types. This is a snapshot of MCX, the trading operation. Illustration, the how the workstation, how the mechanism happens, like in the case of how the orders are placed by the clients, and how what is the different modes through which it reaches the technology, the exchange level, the matching machine, and how the matching happens, and what is the kind of the infrastructure that is prevailing, like how the kind of modes that is available. So this in the case of MCX. So in a similar way, there are different technologies being used. In the case of exchange MCX, they use a specific type of technology, whereas in the case of the other national level exchanges, be it NSE, be it the BSC or NCDA, they have different technology, exchange technologies, which they use in terms of for this anti-trading mechanism. So in the case of trading workstations, this is how it looks like. Towards your left, it gives a pictorial depiction of how the trader workstation is going to be. So the kind of architecture, at the client server architecture, how the entire flow of data happens, and the in the case of MCX, this server software is a Stratus, whereas in BSC it's Bolt and other things. In the case of other exchanges. So there are different technologies being used by various recognized stock exchanges. And apart from that, the trader workstation also ensures the uptime, like they delivers 99.999% uptime. So this also ensures there is a greater faith on the electronic mode of trading on the exchange platform. And apart from that, there is the feature of data feed that is going to be available on a real-time basis, which is going to be beneficial for all the stakeholders. And apart from this, there is a disaster recovery site, which will ensure in the case of any adverse situation where the exchange operations comes to a standstill, where there are few instances also as well. So in that case, how the disaster recovery site functions. So parallelly, the online data is going to be replicated on the DR side. So as and when there is any disturbance or because of any failure or any other reasons which results in stoppage of trading on the exchange platform, obviously the disaster recovery site will play a vital role. Immediately it will be taking the load, and in turn the trade process continues with the help of DR side. So let's have a quick look at the types of orders. In the case of types of orders, basically we can segregate into time-based or price-based. So once somebody wants to come and actively play a role, take trade position on any exchange platform, so they should first of all understand what is the kind of facilities, order facilities that is available. If it is a time related conditions, then basically it is going to be day order. like where India order, somebody can place an order. That order will be executed in that specific day. If it is not going to be executed, obviously, the order is going to be cancelled. So basically here in this case, it remains active, throughout the day, until, it is executed. If it is not executed, it gets cancelled at the end of the trade. And in the case of, good till cancel, so here the order is going to be active till it gets, cancelled. So in the case of, somebody puts an order on a specific, contract. So obviously this is going to be active till the, date of, the contract expiry date. Suppose the specific, execution date is going to be, much prior to the expiry of the contract, then it will get executed. Suppose, the date, they have indicated, till it is cancelled. Then if it is not cancelled, then on the date of the expiry of the contract, automatically by default, it is going to get, cancelled. So if it is executed before the expiry of the contract, then it's fine. If it is not executed before the expiry of the contract, then obviously, it is going to get cancelled on the last day, that is the end of the expiry of the contract. In the case of other option, that is immediate or cancel order. So here the order gets executed. If by any chance, if it is not executed, it gets cancelled immediately. And in the case of good till date, so this is again close to, like good till cancel. So here it will be active, till the expiry of the contract. On the last trading day of the contract, if it is not, executed, then obviously this is going to get cancelled. So here, these are the various time-related conditions. So a trader, who can, will have this following, various options, whether he can opt for day order, whether he can opt for a good till cancel, or he can also put an order where it can get immediately executed or cancelled. Or he'll also have an option to offer good till date. So these are the various time-related conditions while putting an order because of a trader. In same way, a trader also has the option of price-related conditions. In the case of price-related conditions, he can again opt for limit order. So he can indicate, specify the price. Suppose for in the case of cotton, he can say, I want to buy, this lot at 20. The current going price is around 25,000, 26,000, somewhere like that. So he can indicate, as per his requirement, basically what is the, he can specify the price at which, he wants to execute the trade. So that is the limit order. In the case of market order, if he is happy with the prevailing, market prices, he might, put a market order. In that case, immediately it will get executed at the prevailing prices on the exchange platform. If by any chance, he wants to go for, kind of better, risk management, then he can also, opt for, stop loss order, where if there is a possibility of any adverse movement which might impact his interest, then he can go for a stop loss order, where stop loss order will ensure the moment, he is, suppose a person specifies a particular price trigger, then obviously, the moment, if there is any adverse movement, and then it touches that particular price, the market price, touches that specified price, then it will, get executed, because he has, opted, for stop loss order in order to reduce or mitigate his risk. So these are the various, price-related conditions, apart from the time-related conditions, which are at the disposal of a trader while placing an order. So once, a trader places an order, either as a proprietary position or as a client level, then what is the next stage? Since the first stage is, placing the order. Once the order is placed, it's not like it immediately gets, considered for, matching. There are, certain process involved where the order has to be validated. So what are the validation process, that is going to be considered before the order is eligible for matching? The one is, the circuit filters, like whether the order somebody has put is within the price range, or whether the lots is within the price range. So all this is going to be validated as per the criteria. Like since the regulator has indicated certain compliances for each of the commodities that are going to be traded on the exchanges. So the order validation process carries out quickly, where it will ensure whether it is the order that is placed in the system is it is meeting all the criteria, or whether there is the size in line with the compliances, whether the market lot is in line with it. If by any chance it is not in line with these requirements, then the order is not going to be validated. So once validation happens, then it's order matching happens. So here, how it is going to be matched? Here, the first thing that needs to be considered is the price. Price is the one which indicates the matching process. So price plays a vital role, and then followed by the time. Suppose we will take a hypothetical example for better understanding of this. Suppose a buyer puts a quote buy order for 100 rupees, and then a seller also quotes indicates that puts a sell order for 100 rupees. Then immediately here, since both of them have put 100 rupees, so here the buy and sell order matches. So immediately the matching process happens. But in the case suppose the buyer has put a quote of 95 rupees and the seller has put a quote of 100 rupees. So in this case either the seller has to come down, has to revise his quote, or buyer has to revise his quote, so that the match happens. So at the same time, suppose there are 2-3 multiple buyers, and one buyer, assume one buyer has put a quote of 100 rupees, the other buyer has put a quote of 100, but of different quantities. Then obviously in this case, what happens is, since the price in both the cases are same, then the immediate thing that is going to be considered in terms of giving priority is the time factor. So who has put the quote first? It's not the quantity that decides, it's the time that decides. So apart from the price, the other subsequent thing that is going to be considered is the time. So price and time are the ones which decides the priority of the orders. Once orders are matched, then obviously so basically how the matching happens, it's the best sell order, best buy order. So whoever offers the more, in the case of buy order, and who offers the least price in the case of sell order, the more order matches. So the matching process is based on best buy order and best sell order. And in terms of quotes, basically it is going to be quoted in Indian rupee, and each of these orders carries a unique order number and trade number with their timestamp. So these are all ensures the transparency in terms of the trading system on an exchange platform. So this is a snapshot of order matching, how it happens, the best buy and the best sell in the case of Chana Dal. So here, this is of course, the price quotes are too low because it's a snapshot which is quite old. But just for your understanding, I will just capture this in my presentation. So you can see towards the bottom hand of this snapshot, the blue ones, where the buy quotes are there. The obviously the one who is offering the highest, the best buy, that is 2427. Whereas in the case of the seller of who is willing to sell at the least price, that is 2432. So obviously the matching is going to happen between the best buy and best sell. So these are how it is going to be prioritized in the order. Coming to order management. So now we understood what are the kind of options available for a trader by putting an order. So after placing an order, what are the parameters that is going to be considered in terms of ensuring the matching of the orders. The subsequent one is the order management, how orders are going to be managed. So here in this case, orders are going to be modified. They have the option of cancellation of orders. So let's have a quick look. What are the ways how these modifications can be carried out, and in which are the situations where there is no option of either modifying or canceling the orders. So in the case of time priority, what is the kind of situation? So in the case of time priority, suppose somebody puts an order, and then later he changes certain quantity numbers. Be it like increasing or decreasing quantity. So in that case, the time priority in this case is going to remain same. Except if there is change in quantity. If it is there is no change in quantity, then obviously the time priority remains as it is. And by any chance, suppose there is going to be an unexecuted or pending order, then obviously there is a option for the trader to get the order cancelled. So if there is a pending order, somebody has placed the pending order, but there is no proper match for that particular price code, then obviously if it remains active in the system, then the trader has the option of cancelling that particular order before it gets executed. Once order gets matched and there is a trade that happens, then the trader the can't cancel it or can't modify it. So till it remains at the stage of order prior to its execution, there are ways where this can be managed. But once order gets executed and trade happens, then the possibility of getting it modified or cancelled is not there. So once we understand the order management in terms of priority and what are the possibilities, in what all cases, when it can be changed, modified, or when there is no possibility of changing it. The other thing, key thing that we need to understand is the close price. How the close price is generated and what are the methodologies how it is going to be arrived at. So for any of these derivative contracts, basically it's the weighted average price of all trades executed in the last 30 minutes, which is going to be considered as closing price. Suppose there are instances where in the case of illiquid contracts, there may not be enough number of trades happening in the last 30 minutes. So if that is the case, let's see what are the parameters. In case there is a less than 10 trades in the last 30 minutes of the particular day, then in that case what happens is then they have to consider the prior period also. Suppose in the last 30 minutes, assume there are only 5 trades that happen. So in that case, they have to consider even the time before the last 30 minutes of the trading day. In that case, they have to ensure there are like maybe 1 hour before and 2 hours before, so that they will have at least that 10 trades that are executed, so that once they get the 10 trades that are executed during that trading day, then they will take the weighted average price of those trades. If suppose in certain narrow commodities there is a possibility even that 10 trades not happening throughout the day also, in such a case, then or there is no trade at all in a specific day, then they can consider the last closing price as the closing price for that particular day. So this is how closing price is arrived. And then coming to the bow copy. So what is bow copy? Bow copy is basically the one which indicates the pricing details, like at what price for a specific contract under a particular commodity, what is the opening price, what is the high, low, or close prices. And in the case of it also provides what is the previous closing price, and it also indicates what is the number of trades that happened, volume and value terms are also going to be provided, and open positions, so that it gives information to the traders and all the participants what is the kind of open interest that is prevailing for the particular contract. And once the bow copy gets finalized after the end of the trading day, then the same is going to be shared with the members through FTP server, and it is also going to be simultaneously information is going to be shared with various information vendors like Bloomberg, Reuters, and all these people. And also it is going to be posted on the exchange website, so that people, traders, active participants have enough information at their disposal. Apart from these things, the other key thing which needs to understand is the price circuit filters. What is this price circuit filters? So basically, price circuit filters are usually predefined in the contract specification. Like earlier session, we discussed about the broad design process, where we have seen snapshot of the cotton and chana contracts. So there, the price circuits has been specified. So basically, this is predefined in the contract specification. So any trader can have a look at the price circuit filters. What is the kind of range of price circuit at the beginning? Before it takes position on the exchange platform. So the price circuit gives a range, like what is the maximum price range in a particular day? How much the price can move? For instance, suppose the price range is 6%, then the price can move. Suppose let's take an hypothetical example. Say a commodity is 10 rupees. Then if there is a price range of 5%, then we have to see what is it can move either way, 5% plus or minus at 10. So in the case of price range of 10%, then there is a possibility of moving by 1 rupee. Like it can come down till 9 rupees, or it can go up till 11 rupees. So this is how there is a price range which determines the range in a particular day, beyond which there are certain compliances before relaxation can be provided. And this price range is not going to be same. It varies for commodities. Generally, the price range is much more higher in the case of non-agriculture commodities because of the nature of the commodities. Whereas in the case of agriculture commodities, considering the sensitivity involved, the price range usually is of lesser number. And how this price range is computed? Basically the price ranges are computed based on the previous day's close price. So in case of excess, where fluctuations, price volatility, where it goes, touches the maximum cap. So in that case, the exchange can relax the circuit filters to ensure better price discovery. But at the same time, there are certain compliances that need to be met. Like in the case of agriculture commodities and in the case of non-agriculture commodities, what is the kind of compliances that the exchange has to meet? Is it required that the exchange has to inform to the regulator? We will have a look at it later. So before the exchanges consider various relaxing the price circuit filter, what are the parameters that the exchange has to keep it in mind before relaxing it? The first thing they have to keep it in mind is what is the market trend? Is it in line with the market? If suppose in market, say for example, China spot market. So if there is not significant price movement and it is somewhere in around, let's take the current prices, it's I think somewhere around 5,500 or so. So if the prices for China is 5,500, but whereas here in the spot market, it hardly moving with a price range of 2% or 3%. But whereas on the exchange platform, suppose there is a significant movement where it touches the circuit filter, then obviously the exchange has to see whether is it because of excessive speculation, which is resulting in higher volatility on the exchange platform, because obviously this is not in line with the market. So this is one of the parameters that the exchange has to consider. Apart from that, they also need to consider what is the last trade price, what is the close price of different contracts. So that also gives some cues whether is there is it in line with the market or is it not in line with the market. And also they need to consider what is the number of trades till then. If there is a significant number, then obviously there must be possibility of efficient price discovery. Then they can take the liberty of relaxing it. But if there are very one and few trades, then obviously there is every possibility of market manipulation. So they have to consider things like the last trade price, what is the spot price, what is the number of trades that happen, and what are the number of orders that are pending before. And in case of global commodities, suppose if the underlying asset is a global commodity, say for example soya or cotton, though the specifications might vary because of the different underlying assets, but broadly if there is a close proximity in terms of prices of the domestic underlying asset and the global commodity moving in tandem, then in those cases, then they can also see the global prices. Is it moving globally also where there's a greater level of volatility because of market forces, or is it only confined to the domestic market? So in that case, they will have greater information at their disposal to take a call whether the circuit filters can be relaxed or they have to look into it. So the regulator has indicated certain guidelines, like in case of price circuit filter, the SEBI has approved like a cooling period of 15 minutes needs to be observed by exchanges. Suppose the price hits the breaches the circuit filter, then obviously there will be a cooling period of 15 minutes, and then post that there is a exchange will have the freedom to relax it further 50% to ensure better price discovery. Because if there is no further relaxation, but because of certain forces, market forces, if there is a curve with a very minimal price range on a particular day, then it is like basically curtailing the price discovery process on the exchange process, which is like defeating the very purpose of the existence of derivative contracts. So obviously, one of the key economic utility of this derivative contracts is price discovery process. So price circuit compliances, the filters plays a vital role. Yeah. So the regulator and the exchanges has to keep it in mind, where they should ensure balance between efficient price discovery process, and also at the same time addressing or curtailing the market manipulation. And once there is relaxation, then the exchange can ensure in order to better opt for price risk management, they can also impose additional special margins so that they can discourage excessive speculation. Obviously, with greater margin levels, there is a possibility of some of these speculators may not be so keen, since the leverages, the advantage of leveraging will come down. So obviously that will discourage some of the speculators. So usually when the prices breaks the circuit, then post relaxation, the exchanges impose special margins to ensure efficient price discovery and not too much of market manipulation. Another important thing is the margins. Margins, what is margins? So basically why there should be a margin on the exchanges. Suppose in derivative contracts, what sort of role it plays. So basically margins ensures guarantee of the performance. Without margins, then obviously there is every possibility of traders or participants are defaulting, so which will result in the clearing member taking the risk. So in order to avoid that risk and go out for better price risk management, so margins are imposed. So generally, what is the rule. I mean, generally margins are imposed, and any trader, I mean, who would like to, I mean, participate on an exchange platform has to ensure that he puts the margin upfront. So basically, we need to understand margins are collected upfront. Say, for example, a commodity contract is value is, I mean, 100 rupees. So if the margin is 10% upfront, he has to ensure, I mean, 10% is deposited with the trading and clearing number. So margins has to be put upfront. And once, I mean, the margins are there, we will try to understand what are the different types of margins. In fact, I mean, margins, there are, I mean, which vary, I mean, from commodity to commodity, depending upon whether it's agriculture commodity, whether it's non-agriculture commodity. Usually, I mean, in the case of, I mean, non-agriculture commodities, the margins are slightly less, I mean, because of the possibility of lesser price volatility. But in the case of commodities, which carries, I mean, higher price volatility, the margins are going to be higher. And apart from the variation based on the underlying asset, there are, I mean, other things like in the case of, I mean, period, I mean, like if the contract enters a tender period, if the contract enters a particular delivery period, then obviously in those cases also the margins are going to differ. The moment, I mean, the contract, I mean, reaches the tender period on the delivery period, then obviously the margins are going to be much higher. Basically, here the idea behind this is, I mean, the regulator and the exchange, I mean, like to ensure people, I mean, especially the speculations, I mean, you know, get discouraged. I mean, once, I mean, the commodity, I mean, the contract, I mean, reaches the expiry date. So they just want to ensure, I mean, only the people with the true intention of giving and taking delivery remains. So because of that, in order to ensure, I mean, compulsory delivery and better price discovery and convergence with the spot market, they will impose, I mean, greater margins. So the moment, I mean, the contracts, I mean, reaches the tender and delivery periods, there will be a different set of margins, which is again going to be specified in the contract specification itself. It's not like going to come at later point of time. So in contract specification, I mean, they indicate, I mean, all these margin details. So in the case of, I mean, initial margin, as we understand, I mean, it is a predefined in the contract itself. But in the case of special margin, so once, I mean, the relaxation happens, then it is going to be imposed. In the case of additional margin, again, it is going to be like the greater the volatility, then there is going to be additional margin which is going to be imposed. And delivery margin is also going to be specified, I mean, at the time of delivery period. And margins are also going to vary, I mean, based on, I mean, the client level. I mean, like they indicate, I mean, you know, what is the, I mean, margins, I mean, that is going to be levied, I mean, at the client level. And they also, I mean, how the system also provides the option of, I mean, provides these signal alerts in the case of members. Like once, I mean, utilization of their margins, I mean, is at 60% or 75% or 90% utilization, then automatically the system triggers so that, I mean, the member is informed that his margins are, I mean, getting utilized. So he has to put in additional margin to remain active, or, I mean, it will get into a square up mode. If he puts additional money as a margin, then obviously he can be in a position to take, I mean, fresh positions. Otherwise, I mean, obviously the existing, I mean, positions will be squared off as a part of, I mean, risk management. This is a hypothetical example, like to better understand how the margin deposit happens. Suppose in this case, I mean, assume, I mean, there is a rupees 1 crore, which is deposited by a member, I mean, as a margin deposit. The moment, I mean, the utilization reaches 60%, that is 60 lakhs, it gets a trigger. And then post that again soon, once it reaches 75% level, then again, I mean, that is 75 lakhs, it gives another trigger. And at 90% level, again, it gives the final alert that the margins utilization has reached, I mean, 90 lakhs. So it's 90% of the margin has been utilized. And once, I mean, it touches the 100% mark, obviously, I mean, it gets automatically squared up. For any portions of that particular number, it automatically gets into square up. Apart from margins, the other key feature in derivative contracts is mark-to-market loss or profit. What is this mark-to-market, M2M loss or profit? Excuse me. So in this case, basically, the monitoring will be happen. I mean, what is the kind of the adverse movement of a particular price of a particular trader? I mean, in case, I mean, there is an adverse movement, then obviously, I mean, his deposit is going to be eroded slowly. So here in this case, once, I mean, the losses, I mean, reaches, I mean, 60%, 75%, 90% levels, there are, I mean, the system by default automatically gives the necessary alerts. So once it reaches, I mean, the 100% level of M2M losses, then obviously it gets into square up mode. So we will try to understand with a hypothetical example how it is going to work like. So suppose somebody has put a deposit, margin deposit of rupees 1 crore. And if there is, I mean, market to market, I mean, limit, obviously, I mean, is at 75%. So in this case, I mean, it is going to be 75 lakhs. Suppose if the M2M, I mean, losses reaches 60% of the 75 lakhs, that is, I mean, 45 lakhs, then it gives the first alert. Post that again at 75% level, that is, I mean, in this case, I mean, 56.25 lakhs, it gives the another subsequent alert. And again, once it reaches, I mean, 90% level, that is 67.50 lakh, it gives the third alert. Suppose that once, I mean, the M2M losses crosses 100%, then obviously it is going to get, I mean, executed because it goes into square up mode in order to ensure, I mean, there is no risk on the part of the claim member. So this is how, I mean, mark-to-market losses, I mean, work. Open position is other key criteria that needs to be understood. What is, I mean, like basically here, what is the open positions that is allowed? In order to ensure, I mean, proper efficient price discovery, SEBI also has prescribed, I mean, certain open position limits at commodity level and contract level. Whereas, I mean, the open position limits, I mean, gets reduced as we move to the near month contract. I mean, basically, essentially here, the regulator wants to ensure that there is greater transparency and there is people who would like to, I mean, give or take actual delivery, you know, would be part of, I mean, would still remain active. Whereas they want to discourage, I mean, the speculators, I mean, so that, I mean, it won't distort the price discovery process. So because of that, they ensure, I mean, the greater margin levels, which in on the position limits, I mean, which in turn, I mean, reduces, I mean, the number of, I mean, participants as the contract reaches the expiry date. And there is also, I mean, guidelines by the regulator, I mean, indicating, I mean, in terms of, I mean, clubbing of open positions, and also, I mean, the monitoring of open positions by the exchanges. And again, I mean, these position limits are going to vary, I mean, for agricultural commodities and also for non-agricultural commodities. So let's try to understand what is the position limits in the case of agricultural commodities. In the case of agricultural commodities, at the member level, it is 10 times the contracts. Like for instance, I mean, let's say a client level open position is X. Then at the member level, I mean, you can ensure, I mean, you know, open positions at 10 times the client level open position limit. Or in case, I mean, you know, 15% market wide open position. So it is like whichever is higher in this case, I mean, will be prevailed. So whether 10 times the numerical value of client level position is greater, or I mean 15% of market wide open interest, whichever is higher, is going to be considered as the open position limit for the member. And in the case of near month positions, obviously, I mean, the position limits are going to substantially drop. I mean, it is usually, I mean, as per, I mean, current compliances, it is 1/4 of the usual, I mean, position limits of any particular commodity. So for instance, I mean, if it is 100, I mean, then the position limit during, I mean, near month is, I mean, like 25. So it comes down to 1/4 of the overall, I mean, client level position limits in the case of clients. And in the case of member level also, it's 1/4 of the overall member level position. So the total overall members what is the total. Suppose in that case, I mean, the overall members open position limit is 100. Then at the exchange level, then obviously for a particular member of that exchange, I mean, it comes to 25 once, I mean, the contract reaches near month position. And in the case of position limits, as we indicated, it is going to be decided based on the categories of commodities, whether it's a sensitive commodity, whether it's a broad commodity, whether it's a narrow commodity. So in the case of sensitive commodities, so how it is going to be considered? I mean, how this categorization of commodities happens. So in the case of sensitive commodities, generally those commodities where there is a frequent government or external intervention, like a bit in terms of stock limits or export or import restrictions or any other trade barriers, then that is going to be considered as the sensitive commodity. In the case of broad commodities, the criteria is like the average deliverable supply for the past 5 years, should be at least 10 lakh metric tons. Or in terms of value terms, it should be 5,000 crore. So that should be the average deliverable supply. So what is this deliverable supply? Deliverable supply is nothing but the production and imports of a specific commodity. So once any particular commodity value terms in terms of production and imports, crosses 5,000 crores, or the average delivery each year is more than 10 lakh metric tons, then obviously that commodity is going to be considered as broad commodity. And what is narrow commodity? In the case of narrow commodity, which is basically the commodities which are not falling under the category of broad commodity or not falling under the sensitive commodity category, is going to be considered as narrow commodities. So in the case of narrow commodity, the position limits are again like 1% of the deliverable supply. So in a particular year, if there is a particular XYZ deliverable supply, then in the case of broad commodities, the position limits can't exceed more than 1% of it. Say, for example, for a particular commodity, in the case of agriculture products, if the deliverable supply in a particular year is 100, then in the case of broad category commodity, it can't be more than, position limits can't be more than 1% at the client level. And at the same way, in the case of narrow commodity at the client level, it can't be more than 0.5% of the total deliverable supply. Whereas in the case of sensitive commodities, since the commodities itself are sensitive in nature, so any adverse price movement is going to have a greater impact on the ecosystem. So obviously, it is much more reduced. So it is only 0.25% of the deliverable supply. In case there is value of a particular commodity going beyond 5,000 crores with increase of more than 5% for the consecutive 5 years, then there is a possibility of those commodities which are considered earlier as narrow commodities can go on to the broad category commodity. So there are the criteria under which a narrow commodity can be moved under broad category if it meets certain parameters. So this is in the case of non-agricultural commodities. Since our primary focus is on agricultural commodities, we can just ignore this. But to just get a quick understanding, basically in the case of non-agricultural commodities, they are much more liberal in nature because of comparatively lesser sensitivity of the nature of the product. And at the same time, even the position limits also varies. In the case of hedges, so there are certain parameters the regulator has approved. So each exchange, under specific commodities, they have certain parameters where hedgers, will have the liberty of having slightly greater position limits, but with certain criteria. So there are some of the salient criteria or hedging limits cannot be transferable from one hedger to another hedger, and there are things like exchanges, stock exchanges has to provide these on their website on a regular basis in the anonymous mode. Means they should not indicate the name of the identity of the particular hedger, but they can provide these are the hedges whose positions are there, so they can indicate all those details. So basically This relaxation is there in the case of hedges to ensure greater participation of hedges and encourage, greater participation of hedges, and also, better price discovery process. This is a quick snapshot, how, the stock exchanges has to provide the disclosure in terms of, position limits in the case of hedges. Like what should the, long hedge limits, what is the, short hedge limits, and when, application approval date, the stock exchange has to approve it. So without any prior approval, all, the hedges cannot, have a different position. So only after prior approval of the stock exchanges, they will have that relaxation. And apart from, position limits, the daily price limits also plays a significant role. So here, in the case of, daily price limits, again, let's have a quick look. In the case of, agricultural commodities, what is the kind of, daily price limits that is prevailing? So in the case of broad commodities, we have discussed already, the categories, which are the broad category commodities, which are the narrow and which are the sensitive commodities under agricultural commodities. So in case of broad, agricultural commodities, the initial slab is 4%, and it can be further, relaxed by another 2%. So in a day, the total, price limit is 6%. So beyond which, it cannot, move. And in the case of narrow commodities, again same. But in the case of sensitive commodity, it's 3% is the initial slab. And once, it touches the circuit, then there is a further relaxation of 1%. So 4% is the cap per day. This is, the previous slabs that was prevailing. Since there was a change, earlier this year, so I just thought let me share, because some of you might have, looked, this particular slab or familiar with this slab, because this was prevailing for a longer period of time. Only earlier this year, to ensure, greater efficiency. And of course, improvisation of the commodity derivatives market. The regulator has revised the slabs and came with the ones which I shared before. So earlier, for in the case of agricultural commodities, it used to be like barley, chili, jeera, turmeric. Having initial slab of 2% and enhanced slab of 2%. And in the case of other agricultural commodities, it's 3% and 1%. But in order to encourage and ensure better price discovery, they have relaxed it. Now it has gone up to 6%. This is, in the case of non-agricultural commodities, the idea here is, basically to make you understand that what is the maximum DPL in the case of non-agricultural commodities, 9%, as compared to agricultural commodities, because of the sensitivity of the commodities. And then coming to the surveillance, now we understood, what is the various, modes of trading and all, and the kind of limits, they, in order to ensure better risk management practices like position limits, price limits, and all those things. The other, key thing, that the exchange has to ensure is, the monitoring. They have to ensure, now the price volatility, the trading pattern, whether it is in line with, the spot market, and also the margin utilization has to be keenly followed, to ensure, there is no compromise as far as the risk management is concerned. And also, if at all, there is any sudden abnormal, increase or decrease in open interest, they should keep a watch for that. And other than this, in case there is a significant jump in turnover of a particular commodity, so that also need to be considered by an exchange. So all these, ensure there is no, or minimal market manipulation. And what is the, the surveillance policies that exchanges follow? Exchanges, have, robust, surveillance policies. So some of the salient ones are, they ensure limited access. People only with the access card can enter that particular premises. And in apart from that, they have closed cameras in surveillance rooms to ensure things are in order. And other than this, they have, ensure, restricted access to certain confidential information, like open position, trade details, margin deposit, etc., etc. And also they ensure there is no direct outgoing call, because the moment, direct outgoing call is provided, I mean, there is every possibility of certain sensitive information getting leaked. So they ensure there is no direct outgoing calls, and even if there are certain calls made, I mean, as a process within the exchange, I mean, the recording of calls is bound to happen. And apart from that, the mobiles are not allowed. So these are some of the, I mean, surveillance policies which are dynamic in nature, which will be keep improvising, which are followed by the exchanges to ensure there is a proper surveillance policy. These are, I mean, some of the useful references, I mean, to just understand. I mean, you can go to the respective websites to understand what is the, I mean, surveillance policies and all. So this is in brief about the trading and surveillance aspect of, I mean, stock exchanges. So thanks for your time. I mean, if you have any queries or, I mean, any other things, I mean, you would like to, I mean, put it across, I mean, whatever way you prefer, either through chat box or, I mean, through email. I'll leave my contact details, I mean, with the coordinators. So you can feel free to get in touch. Thank you.
Yes, sir. Thank you so much.
Okay.
Yeah, thank you.
Sir, you have delivered all the things very nicely, and you have elaborated all the things related to our contract design for agriculture commodities. You covered the topics like essential components of commodity future contracts, principles of commodity future contract design, key parameters, product suitability analysis, promotion of conversions. There are many topics you have covered in a very broad and in a very well manner. So regarding to a few queries we have collected from our participants, and we want to just ask you, sir.
Yeah, please.
Like, sir, how we can check the prices? The prices are discovered on the future markets is efficient, because
Right.
in many of yeah. Okay, how we can say that the prices are efficient? Is there any? Yeah.
See, to understand, I mean, whether the price discount on the exchange is efficient or not, there are, I mean, various parameters which we need to consider. I mean, whether there is, whether the prices, I mean, discount on the exchange platform is in line with the prices prevailing in the spot market. Okay, and
Okay.
at the expiry of the contract, when we can check, I mean, whether it is converging with the spot market prices.
Okay. So
Okay.
accordingly, we can see
Yes.
how the prices which are discovered on the platform is the
Yes.
efficient.
Apart from that, I mean, in terms of number
Yeah.
of participants, the type of participants, all these give, I mean, some sort of cues to what extent, I mean, the price discovery is efficient on an exchange platform.
Okay. Sir, in one of your slides, you have discussed about the price elasticity is impacted on designing the contract in our first session.
Yes.
So, because we know that in our agri commodities, most of the commodities are inelastic in nature.
Right.
But with regards to our future markets, other than agri commodities, we are having the contract. So, what about the price elasticity and inelasticity with regards to our commodities, which are we are using for the contracts on future markets?
See, basically, what I mean to say is, if there are, price inelastic, obviously, there will be greater, I mean, volatility, right? Because suppose the demand is going to be constant and there is a supply shortfall, then obviously that will result in, I mean, greater, I mean, volatility, because obviously there will be higher demand, but the supply has come down. And it can be vice versa also. Suppose, I mean, the supply is inelastic, because it is not like something which can be controlled, I mean, in a particular season. Suppose the sowing happens. Obviously, irrespective of the price, that is going to be, the produce is going to come into the market, right? So here in this case, again, there is an inelastic supply. So it more, I mean, depends on the rainfall and all, right? In the case of agriculture commodity. So these are the factors which will result in greater, I mean, volatility of prices. So in that case, obviously, I mean, if there is a mechanism, derivatives contracts are in place, then that will provide, ensure, I mean, greater, I mean, hedging practices, I mean, by the stakeholders. Okay, so obviously, the greater the volatility, the possibility of, I mean, the contract being a success is higher. But it's not necessary, or it's not going to guarantee that the contract is going to be success, because there are other parameters such as, I mean, the market size, the number of stakeholders, and the geographical spread. All these factors are also going to play. play a role, but definitely, I mean, the price volatility plays a significant role in terms of success of contract.
Yeah. Sir, another query is that what is the tick size? Somebody want to know what is tick size and how to decide the tick size.
Yes, tick size is like, for instance, I mean, we take chana. Suppose the price is 5,800 per ton, I mean, as of now. So then what should be the change in the price? I mean, whether it, suppose somebody wants to, I mean, quote a price, right? So
Yeah.
what is the change? I mean, like, suppose he wants to quote a price. I mean, whether it should be like he wants to increase it or decrease it, then to what extent, I mean, he can increase it or decrease it. Suppose the tick size is 1 rupee, then he can quote, I mean, 5,801, or he can reduce it 5,799. So that 1 rupee is the tick size here. So basically, this tick size is important, keeping in mind that it is in line with the market practices. Suppose in market, for a 1 ton of chana, what is the usual price movement? So in an exchange platform also, they have to ensure the tick size is in line with the market practices. Then obviously, I mean, there will be better price discovery. Otherwise, what happens if it is not in line with the spot market practices, then nobody is going to come and quote a specific quote. I mean, because he, suppose somebody quotes, I mean, 5,850 paisa. Okay.
Yeah.
So in this case, I mean, since it is not in line with the market practices, the rest of them, I mean, there won't be any matching orders, right? So because of that, I mean, the tick size, I mean, plays a vital role in attracting, I mean, participation.
Yeah, sir, thank you so much. Then regarding to our second topic, sir, trading and surveillance, only 3 queries I am having. So what about the cooling period, sir? What is the cooling period you have mentioned in one of the slides regarding to price circuit filter? Yeah.
Yeah. Once, I mean, there is, I mean, the circuit filter is hit, then there is a cooling period. So here, I mean, first, I mean, there is a initial, I mean, suppose the initial margins, I mean, price limit range is, I mean, 4%. Then once, I mean, I assume, I mean, in a particular commodity and in a particular contract, the price, I mean, hits the breaches the, I mean, circuit. So in that case, what happens is the regulator has provided, I mean, specific, I mean, parameters where the stock exchange can provide a cooling period. So the cooling period is the period when they will be keenly observing for 15 minutes, where the prices can be quoted within that initial price range only. But after the post that 15-minute period, still, I mean, if the stakeholders or the market forces think, I mean, that there is a need for, I mean, to revise their quotes, then they can, I mean, quote higher or lower, I mean, prices. So in that case, what happens is the exchange, I mean, gives that 15-minute cooling period to ensure basically, if at all there is a excessive fear or any other factors, I mean, which might have resulted in excessive movement, that can be curtailed. So suppose, I mean, if there is a genuine, I mean, movement in the prices, be it in the domestic spot market, or suppose in the case of global commodities, be it in the global markets. So in that case, I mean, the exchange, I mean, anyway, after the cooling period, it will further relax it as per the compliance. I mean, be it, I mean, in the case of agriculture, there will be 2% or 3%, or in the case of non-agriculture, it will be that respective, I mean, 3% or whatever it is. So that cooling period is basically a period where, I mean, they just want to, I mean, choose the, I mean, emotions, I mean, that fear factor, so that, I mean, efficient price discovery happens. It's not like a result of some other forces. So once still, I mean, the market, I mean, is moving in a particular direction because of the other cues from the spot market. Obviously, I mean, there will, of post that cooling period, there will be further relaxation. So once that relaxation is there, that is going to be the price range for that particular day.
Okay, sir. Sir, another I have one query. You have explained about the order matching. So sometimes the conditions has happened like the order is not matched. Then what will happen? Yeah. If
No, I
this
mean,
any okay.
That is, I mean, like, suppose orders are, I mean, posted. I mean, once the orders are placed, then what happens means, again, it depends upon the type of order. Whether, I mean, it's a good till date, means it will be good for a specific date, or, I mean, it is good till, I mean, cancelled. I mean, till it is cancelled, that will remain active. So in that case, what happens means, if there is no order matching happens, that will remain till the expiry date of the contract. Or if the suppose a good till date, that specified date is before the expiry date of the contract, then the obviously it will be cancelled. Suppose, I mean, if it is not executed, so there is no trade happened, so that will remain active till the expiry of the contract. And on the expiry of the contract, obviously that order gets cancelled. Suppose if there are orders, I mean, placed which are, I mean, market orders, that will get immediately executed if there are any specific orders, I mean, market orders. If not, I mean, it gets immediately cancelled. So it depends upon, I mean, the type of orders.
Sir, one more also, one of the participants want to ask, how the electronic negotiable warehouse receipt beneficial to the farmers and the FPOs?
Yes. So basically here in this case, the electronic negotiable warehouse receipts is going to be helpful in terms of giving that, I mean, financial leverage. Suppose somebody wants to, I mean, come and participate on a commodity derivatives market. So in this case, what happens by opting for electronic negotiable warehouse receipt? So he will be holding that, and he can, I mean, ensure, I mean, pledging of that, I mean, warehouse receipt, I mean, with a banker, and he can raise the financials. So basically, by having such, I mean, negotiable warehouse receipt, he can, I mean, ensure more fungibility. I mean, like he can, I mean, deposit with a banker and raise the credit, or I mean, any other credit provider or with any other financial institution, and then he can raise it. So that is how, I mean, a farmer or producer or any other participant will have that, I mean, leverage of having a electronic warehouse receipt section.
Okay, sir, last one only. Will delivery margins be charged to options buyer and seller? Somebody want to ask.
Yeah. See, so that again, I mean, depends upon, I mean, the kind of commodities. So in the generally, I mean, it is imposed on the buyers, because sellers obviously, once, I mean, he indicates his intention to deliver, okay, then there is a possibility of, I mean, a buyer, I mean, defaulting his commitment. So in that case, I mean, so basically it is going to be imposed on, I mean, the buyers during, I mean, delivery period. But again, I mean, it depends upon, I mean, varies from commodity to commodity. What is the, I mean, like limits?
Okay, sir. Thank you so much, sir. You have explained each and everything very nicely, and we it's our opportunity to listen you, sir. Thank you so much, sir.
Thank you, Dr. Kangaji.
Thank you, sir. Over to you, Shraddha.
Yes, ma'am. Thank you so much, sir, for educating us. Now, to move on, to deliver lecture on clearing and settlement in commodity market, we have with us Dr. Venkatchalam Sunmugam, sir. In the morning session, we have Sunmugam, sir. So we all quite know about him. But in his introduction, I would like to say, sir is currently working with National Institute of Securities Market as a consultant commodities education cell. Sir has rich experience in global policy analysis as connected to trade, market, and market institutions and developmental economics research. He has been a natural thought leader and trained macroeconomist. He had last worked with Multi-Commodity Exchange of India Limited as head of research and index administration. Sir had worked with stakeholders and market participants in the terms of product design and regulatory guidelines. As chief economist at Multi-Commodity Exchange of India Limited, Sir has structured pragmatic policy recommendation based on the foresight about its linkages with various aspects of the real economy and its impact on stakeholders, investors, producers, savers, intermediaries, institutions, leading to the balanced and sustainable growth of the economy at large. So I warmly welcome you for the technical session 2. Over to you, sir.
Thank you, Ms. Rita. So is the screen visible?
Yes, sir.
Okay. So you heard Mr. Prasad talking to you about the twin functions of the market, which is price discovery and price risk management. So it is exactly for that purpose the market has been created actually. So while the market has been created for these functions, which is price discovery and price risk management, but there are various risks which the derivatives market are exposed to because of the way they function and the way they are regulated and things like that. So those also would have to be appropriately looked into and controlled and things like that, which is what a part of that which you looked into, wherein so all of these derivative market, to buy 100 rupee worth of commodity, you just pay 5 rupees or 6 rupees, and every 1 rupee increase in the price of the commodity is a profit for you. So it is a leveraged product. So you pay margin, which is very highly leveraged. That means for 100 rupee worth of a commodity, you just pay 5 rupees, as margins. It's not paying, you just keep 5 rupees as margins actually. So your cost of participating in the market is just the interest rate on that margin actually. So to that extent, there is an incentive for you to manipulate the prices to whatever extent that you want to, but that has to be appropriately monitored and controlled. And this is where the surveillance of the exchanges comes in. And second thing is about price limit, which Mr. Prasad talked about, is another instrument which is in the hands of the exchanges, which control on a given day. Let's say, for example, price of Tur is going to be 100, and on a given day, the price of Tur cannot exceed 104, cannot fall below 96. The 4% is the price limit actually. So that from where exchanges get these price limits, it's by the analysis of the historical prices of Tur in the spot market. They get the price limits, and these price limits are used in determining to what extent the prices can move. And the third, by which one can control the prices or manipulate the prices, you create a large position in the market. And then you can manipulate the prices because you have a large position in the market, and you can move the prices up and down due to your large position, because a large player can always create a larger price momentum in the market. So the market has to prevent this from happening in the in the derivatives, so that it doesn't become a tool in the hands of manipulators who want to manipulate the derivative markets and the price discovery process. Actually, that is done by putting a position limit, which is in comparison with the open positions that are there in the market, and also in comparison with total deliverable supplies actually. So you've seen total deliverable supplies based position limits which are imposed from Mr. Prasad's presentation in the earlier one. So there is another position limit which is also comparative to the total number of open positions that are there in the market, which is also something important for us as well to understand. And the second problem to price discovery happens because of the policy interventions. There are a lot of policy interventions that happens in the market, and that has to be, taken into the markets by way of price discoveries. So the point that I wanted to say is, sugar exports are allowed all of a sudden. Till today, sugar exports are banned, and from tomorrow, sugar exports are, allowed, and suddenly the market spurts out actually. So that is always a risk which markets will take it. What happens in the market is that if there is any commodity where there is a policy intervention risk is there, people would not trade. Actually, what happens in that particular commodity where there is a policy risk, they try to find out what is the policy, price of the policy risk which is there, rather than the price risk in itself actually. So the commodity never gets any liquidity in that particular market actually. There is another problem which is there in the market, which is the wrong or the faulty underlying market. So when you don't have the right product, which is the underlying product, then there will be an impairment in the price discovery, and there will be a divergence between the spot and the futures prices, which is where the exchanges, what they do is they collect the spot prices and they disseminate the spot prices so that you remain tuned to the spot prices, and whatever the future prices, your spot prices plus the cost of carrying that particular commodity to a future point in time, plus or minus the fundamentals which may remain at that particular point in time actually. So that is an equation market always takes into consideration, and to facilitate the same, the spot prices are pooled and announced in the exchange terminals. Another way by which the exchanges or the regulatory system also enables there is no divergence is by making convergence of the contracts by means of physical delivery of the products. Almost all metal contracts, all agricultural commodity contracts, except for palm oil and soybean oil, all the products today are physically deliverable. And if you have an open position and you created that open position at a with a manipulative intent at a price which is either too high or too low, then you will be forced to deliver if the market believes that it cannot go so high or so low actually. So you will have to deliver it at that low price, and you will have to take the prices, that particular price into your hands actually. So that's a punishment that you have to take. Or otherwise, if you believe it the other way, when you are buying the commodity, then probably you will have to take the delivery of the commodity at such a high price. And so even if you take the commodity and go to the physical market, you will not be able to gain any profit out of it. You will be at a loss. So the market ensures that the convergence is there between the spot and the futures market. And other risk to the price discovery is the systemic risk actually. And that systemic risk is coming because there is a counterparty between every trades, and that counterparty is could probably default, and the exchanges will not be able to manage this default and things like that. And to manage it, so exchanges have their own liquid assets which are collected in terms of margins, in terms of members' net worth and disclosures that they have, and according to the exchanges, all the trades are cleared through the clearing house or the clearing corporation of the exchange actually. And that clearing process is a robust clearing process and ensures that, like, at no point in time the exchange will leave anybody with any default which is not compensatable, because exchanges gives that counterparty assurance actually. So I acting as a counterparty, the clearing corporation acting as a counterparty, ensures that every trade is cleared on a daily basis and also at the time of final settlement of the commodity. So similarly, there is always a possibility for a price risk management side. Financial default happens, physical delivery default happens, and there are systemic risks as well, which is managed by way of creating a fund to manage those systemic risks, which is settlement guarantee fund. So we'll look at it in these following slides actually. So if you are a participant in the market, you will have to participate through either a trading member or a trading cum clearing member. If you are participating through a trading cum clearing member, you'll facilitate all the services, right from enabling you to create a buy or a sell order, and that be matched on the exchange with the collection of the margin, and that after getting matched actually remaining as an open position in the market, and then you carry on that open position till the end of the the settlement period of that particular contract, and then get it delivered. So they enable you end to end actually. If he is a trading cum clearing member, if he is a trading member alone, he will only collect the margins. He will enable you to trade in the market, and he will connect you to a clearing member who is associated with you, through whom you will have to take care of your day-to-day margin, mark-to-market margin requirements, whatever the additional initial margins that needs to be filled up, and whenever there is a delivery period margin that comes into picture, that is being taken by the clearing corporation. And prior to the expiry of the contracts, there is a pre-expiry margin that gets levied, because as you go nearer to the delivery of the contracts, the volatility of the prices of the commodities increase, and hence the exchanges would always want to remain safe by collecting a higher margin by way of imposing pre-expiry margin actually. So from 5, 6 or 10%, it gradually increases to 30% or 35% of the total value of the commodity that you need to keep as a margin deposit. It's not you pay, you keep as a deposit with the clearing member, who again posts that margin to the exchange in order for him to enable to manage this position on the market actually. So that's another thing, exchanges do that. And in addition to that, exchanges also keep a track of what is the minimum liquid net worth requirement, whether it is being met by the clearing members or not. And every day basis, there is a closing price which is calculated and announced in the market, and day-to-day mark-to-market settlements at the end of the day, so that the risk that you have taken today because of a falling price or a rising price is settled between the buyers and the sellers on a daily basis, and exchanges do not allow you to accumulate those risks over over a day, and that has to be settled on a daily basis. So today, if you have bought soybean at 100 and tomorrow that soybean prices had fallen down to, let's say, 95, the 5 rupees have to be paid tomorrow as the mark-to-market settlement actually, and that settlement will have to be paid before 11 o'clock or 11:30, and then exchange collects it from you as a buyer and pays to the seller actually, because he has to get that 100 rupee when his contract is settling down actually. So net to net, he has 95 rupees worth of the commodity in the market with the contract which is there in the market, and he has 5 rupees in the hand, and he entered into the market at 100 rupees. So he has 95 plus 5, which is 100 rupees. So that's the way that mark-to-market settlement happens. So that is also called as MTM, mark-to-market margin. So that margin is different from this margin, which is a security deposit actually. So that margin is collected from a losing party and paid to the party who's on the other side, who is gaining from their losing position. So net to net, let us say if the exchanges have 10,000 crores as as the turnover, and the volatility is about 2% actually. So that basically means 200 crores is something would have been lost by the participants in the market, and 200 crores would have been gained by the same set of participants on the opposite side of the market. So there are 100 participants for our simplicity sake. 50 sold and 50 bought the commodity of the same quantity. Then the losses of the 50 is taken from one side, and losses of the gains are paid to the other side. So that's the way that it happens. And then there is a base minimum capital requirement which the exchanges impose on the membership, and they ensure that that base minimum capital is actually kept with the exchange. And there is always a settlement guarantee fund, and that settlement guarantee fund is done through sensitivity analysis that they do on portfolios of major 10 or 20% of the total members, major 10 members or something like that, and their portfolio is analyzed for extreme price movements that can happen in the market on any particular given day. And hence, if there is any extreme movement, and if all these 10 large traders go unable to pay their mark-to-market margin, so how would the exchange have enough amount of settlement guarantee fund to pay for the counterparty risk that the clearing corporation is standing for? The clearing corporation does that sensitivity analysis and manages the settlement guarantee fund at the level which is prescribed by the regulatory requirement. And in addition to that, there is always these concentrated positions which are created in some of the commodities, because the volumes of the open interest is very low, but somebody is having 60%, 70% or 80% of the total open interest, then that results in concentration, because the 80% or 90% of the guy moves in the market, the prices tend to move along with what he wishes, where the prices should be. So there is always a concentration margin so that it doesn't result in higher price volatility. So this is the way that risk is managed in most of the stock exchanges. In addition to that, there is always the surveillance, activity which is being taken up by the exchanges, as explained by Mr. Prasad. So again, these are like of several types, which is monitoring the market, intraday price brand, revisions actually, and alerts, whether a particular person is having enough of margin with the exchange or not, and analyzing the alerts and then taking action based on those alerts. Real-time position monitoring, whatever the number of position that you create is within the limit which is being created, which is being given by the regulation and things like that, and whether there are any advisory calls or caution calls are being provided. The exchange looks at it, and sends the observation letter, calls for explanation. And if it is, proven to be somebody had done that, and there is a penalty which is levied on it actually. And from the position limits, which I told you has makes the market vulnerable to price manipulation. It is monitored at the member level, client level, and things like that. And they are actually disseminated on the exchange website. So, what are the functions of the clearinghouse? The clearinghouse does both day-to-day settlement and final settlement of the contract. Always understand that when you have bought a commodity and somebody had sold it, actually, you have created an open position in the market. And that open position, if you carry that without squaring off the position, that is called as open position carried over to the next day. And the price risk that open position is taking based on the price at which the position has entered into the market and the closing price that is announced in the exchange based on the formula that they adopt, which is 30 minutes, last 30 minutes average prices of the commodities. And if it is lower, depending on whether you are gaining or losing, you will have to take profit or pay for the losses that you taken in the market. And so thereby your position can be allowed to be continued in the market. And that is done on a day-to-day basis, actually. So the clearing corporations do not allow you to accumulate the price risk out of the momentum of the prices that are happening in the market beyond one day. So that is one thing which is done by the clearing corporation. The other one is there are final settlements which are happening at the expiry of the contract. In the final settlement, if I am a buyer, I have to pay the exact amount of, let us say, for example, 5 tons of soybean, and each ton of soybean is around 90,000 rupees. For example, 9,000 is, around 9,000 is today's price, and September is ending up at 90,000 rupees per ton. So you have to pay 4,50,000. And at the time when you pay 4,50,000 rupees, the margin will be paid back to you. Margin, because as I told you, is just a deposit, and that margin will be paid back to you actually. And in addition to that, as I said, the stress testing or sensitivity analysis of the portfolios of the brokers also help the clearing corporations to manage settlement guarantee fund to take care of extreme losses that the clearing corporation may take on the exchange. On the clearing side, who are the participants who actually fulfill various requirements which is there in the market? Is you have the clearing members who does the clearing of the positions, and you have the banks who enable the financial transactions so that the mark-to-market payments can be made, so that your final purchasing, if you are a buyer in the market, the final pay-in by you can be done through the bank to the exchange through the clearing member. And then there are these repositories. Repositories are nothing but the electronic warehouse repositories, which are created by the WDRA under the WDRA regulation. And there are today 2 commodity repositories that are functional, which is CCRL, CDSL Commodity Repositories Limited, and another one is NERL, which is NCDS Electronic Repositories Limited. So these repositories enable that the goods are appropriately quality assessed, submitted into the accredited warehouse, which is accredited by the exchange as per the Securities and Exchange Board of norms. And then another one participant who's coming into the market is custodians, actually. The custodians are no one but are people who facilitate your mutual funds or some large alternative investment fund. If they are holding any particular commodity, they don't hold it against their name, they hold it in their name, but it is being managed by the custodians actually. So custodians are also another key participant in today's commodity market, because we have mutual funds, we have alternative investment funds who are also allowed to participate in this market. So these are 4 different types of participants who are there in the entire clearing process, which happens on the exchange. So clearing, as I told you, happens through the clearing member, and the clearing members' positions are netted out on any particular day. And for that net position, the margins are calculated, and it is looked at whether enough amount of margins are there or not actually. And the clearing member in turn looks at if he is managing some of the trading members, he will compute all the obligations of the trading members and determine positions, how much to be settled and things like that. And then he will also do the final settlement at the time of delivery of the commodity, also which includes commodity pay-in and commodity payout, and the funds pay-in and the fund payout, which is very important for you to understand. There are 2 simultaneous transactions which happen. I, as a buyer, I pay in the funds, and then some X as a seller, he does the commodity pay-in into the accredited warehouse, against which the quality is tested, and then a warehouse repository receipt is created, and that is confirmed by the electronic repository, and in turn the payment is received from the buyer is passed on to the seller. Simultaneously, the ownership of the electronic negotiable warehouse receipt is transferred to the seller. So there is no good which gets transferred between the buyers and the sellers. It is just the ownership is transferred from the seller to the buyer at the time of the delivery, actually. So that is another thing which you always have to remember. There is no trucks getting in and getting out to enabling delivery of the commodity. So if you want to deliver the commodity even 5 days before the expiry of the contract, you can actually deliver the commodity, quality test that commodity, create an electronic negotiable warehouse receipt against it, and then you can tender for the delivery of the commodity, and that tender goes and matches with somebody who wants to take the delivery of the commodity, and then you deliver it and you take away the prices based on whatever is the final settlement price, which is announced by the exchange. And all these transactions happens through the banks. So that is through a particular clearing account, which is being managed by the clearing member. So in this clearing account, the clearing member is supposed not to do any transaction other than only clearing the positions. Whatever that he has to pay for his own maintenance, his own fixed costs, his own staff salaries, that will have to be in a separate account. That is the point that I wanted to say over here, that the bank will have to have a dedicated clearing account with a designated branch of empaneled clearing banks. So that is another thing which clearing members ensure that it is being done. So what is the clearing mechanism? The clearing mechanism is nothing but, end of the day, you've sold 100 contracts of soybean and you have bought 50 tons of soybean. You have a net position of 50 tons of soybean in a particular contract which is open. And that net position is basically looked at and in terms of margin calculation, whether you are having enough amount of margin or not. And all these positions are marked to the closing prices and seen to it that losing parties the money is taken out of the losing parties, and the gaining parties are paid off with the money who had gained from the price movement which had happened yesterday, which is calculated and announced at the time of closure of the market action. So that's done for all the open position which remains open at the end of the day. If you want to close it, you have to square off. What is squaring off means? If you have bought a commodity, somebody had sold it, if you want to square off, you will have to sell that commodity and somebody would have to buy that commodity, then your position becomes null. If you have not done that, you have not squared off your position, you are still remaining in the market, you have to pay the mark-to-market margin, and you can only then you will be allowed to continue with your open position in the market. And otherwise, there will be a penalty and other things which will start automatically applicable on you. So that's another thing which you have to happen. What's the settlement schedule? Actually, Settlement schedule on an everyday basis happens at around 11 or 12 in the noon of the next day, that you have to pay all the losses that you have taken. And all those who have profited, their accounts will be credited by the exchange automatically, through the sweep in and sweep out process actually. And that happens on daily basis to take care of the mark-to-market settlement actually. And the settlement mechanism also is about the final settlement which happens, which is, it is a final settlement price which is announced, and on that basis, all final settlements are will happen at that expiry time of that particular contract actually. So for example, let's say for the soybean is the futures contract for September is supposed to expire on 30th of September. 30th of September is your contract expiry day. On that particular expiry day, the final settlement price is calculated and announced, and anyone who's having an open position on that particular expiry day will have to enter into compulsory delivery of soybean, or otherwise during the tender period, if you have said that. So there is a tender period, there is always an expiry day actually. So between the tender period and the expiry day, you can still square off your positions, but people usually do not wait till the tender period. They actually roll over their position if they want to have a continuity in the exposure, because the contract that they are into is going to expire. They roll it over to the next month contract. That's what is called as rollover actually. And if you don't want to, if you want to close down your position in that particular contract which is expiring in September, you square off your position before the tender period, and then you don't face that illiquidity of the market in which you will have to sell in a hurry-burry, and you may have to pay a price which is not actually reflecting the market conditions and things like that actually. That's the final settlement. And daily settlement, as I told you, which is based on the closing price which is announced in the market everyday basis actually. So that is your mark-to-market payment, and mark-to-market payment happens until the expiry date. So until the expiry date, depending on whatever is the closing price which is announced by the exchange, mark-to-market pay-in is something you have to keep on paying. And to that extent, you need to keep your funds, the clearing members have to keep their funds in their clearing account, so that exchanges do not have to resort to penalty measures and declaring a member as a defaulter or whatever the disciplinary action that is supposed to be taken on that member who is not having or maintaining sufficient amount of funds actually. And then comes the final delivery. At the time of final delivery, as I told you, there is commodity pay-in and a commodity payout. What commodity pay-in means, you take the commodity to the warehouse, accredited warehouse of the exchange. Let's say for soybean, Indore, there is an accredited warehouse which is there in the commodity specification, which is announced by NCDAX actually. So you will have to go to that exchange. You will have to tell them, I want to deliver that particular commodity or store that particular commodity, and so kindly take it in. So he has list of impaneled assayers. The assayers will come in, take the samples, whether it is matching with the quality of the commodity or little superior to it. And if it is superior to it, then if you are eligible for certain premiums, you can take premiums. But if you are not eligible as per the contract specification, you will have to forego that premium, and you will have to sell at whatever is the quality which is deliverable on the exchange actually. And in addition, if there is any GST which will be applicable, in most of the agriculture commodities, no GST is applicable. But in many of the non-agriculture commodities, the GST is also applicable. The exchange ensures that the GST is paid by the seller, and it is collected, the GST receipt is collected and passes on to the buyer. So that's the post-delivery activity which happens. And if in case there is a default that happens, there is a set default management procedure that will get activated, as per which the defaulting party will have to pay the penalty, and a part of the penalty will be shared with the party on the other side of the defaulting party, who is losing whatever the gains that he has in the market, and he will be compensated financially by way of the financial settlement process that is existing in the market actually. So there is this exchange clearing house, and you have the margins, you have the daily and payment settlement, and all this is part of the settlement process flow, which you have to understand that as such. And in the delivery process, today, as of the day, there is only one delivery process that is prevalent, which is compulsory delivery. Otherwise, normally in the delivery processes, there are seller's option that the seller decides whether he wants to give the delivery or not, or the both options market where both the buyer and the seller will have to agree to it. So mind it, in today, for all compulsory delivery contract, it is, or for all the agricultural and metal contracts and the precious metal contracts, it's all compulsory delivery. That means if you are keeping an open position, you will have to come and deliver the commodity actually. So how do you deliver that? There is a process to get it delivered. During the tender period, you will have to intimate the exchange of your intention to deliver. And if you are a seller and if you're a buyer, you will also have to intimate your intention to take the delivery of the commodity. And the exchange disseminates the intentions into the market, and these intentions are matched by the exchange at the time of tender period, and all the matched intentions at the time of expiry day, on the date of expiry, will get into delivery on E+1 period. The commodity pay-in and commodity payout happens, and the funds pay-in and the fund payout happens. As I told you, the commodity pay-in and commodity payout is not by way of moving in and moving out of the commodity, is by way of the change of the ownership of the electronic negotiable warehouse receipts in the case of agricultural commodities, and in the case of non-agriculture commodities. There are repositories which are managed by the exchanges working with the warehouses, and they reflect the title of, if I have bought it, I will be able to get into the exchange repository mechanism and see whether I am actually having that 5 tons of aluminum or 2 tons of zinc, which I would have bought, is there reflected in my name or not. It is similar to a share certificate. You can get into the depository account and see that whether you are really owning that share through the broker's account, and see that whether you are owning it or not actually. So similar to it, you can see whether you are owning that particular non-agricultural commodity also on the exchange accounts actually. So this is the way the delivery process happens, and it happens, as I told you, on the day 2 after the expiry day +1, the fund pay-in and the fund payout happens, and the payout to the seller happens at 5 o'clock in the evening, and the pay-in of the commodity is supposed to happen by 11 o'clock in the morning, actually 11 o'clock in the morning. The seller will have to deposit his commodity on the expiry day at 11 o'clock on E+1 day. The commodity will be transferred in the title of the commodity, or the electronic negotiable warehouse receipt will be transferred to the buyer, and simultaneously the funds from the buyer will be transferred to the seller. So that's how the delivery happens. And this is the process on the seller side. This is the process on the buyer side, which the clearing corporation will have to undertake, and the clearing member will have to be conscious about actually. And these are the entities, and as I told you, funds pay-in, funds payout, and the delivery pay-in or the commodity pay-in and commodity payout happens between the seller and the buyer, and all of that pay-in and payout of the commodity is by way of ENWRs actually. Electronic negotiable warehouse receipts for the agriculture commodities, and the electronic receipts which is issued by the exchanges through their own receipt mechanism for the non-agriculture commodity. And deliveries can happen through a staggered delivery period. So some of the contracts in agriculture commodities have a staggered delivery period. So after the tender period comes in, there is a staggered delivery period during which you can take or you can give delivery. And at the time of expiry, you have to end up deliver. So there is a difference between staggered delivery and expiry. Staggered delivery doesn't mean that you are obligated to deliver at the time of that staggered delivery period. But yes, the liquidity will go down, So you may, in a way, indirectly be obligated to deliver, because you will not be able to buy your contract back because there are no sellers on the other side. So you will have to deliver that commodity and get out of that commodity position. So by way of holding that position through the staggered delivery period. So there are some commodities, in which there is a staggered delivery period, which varies between 3 days to 10 days. And during the staggered delivery period, the commodity futures contract typically operates like a spot market. The prices are almost near to the spot because you are taking that commodity on that particular day. So it acts like a spot contract actually. And there is always an early delivery system which is possible. And you can always enable, early payout only happens on the defined day. It doesn't happen prior to it. You can always, do a commodity pay-in prior to your delivery. You can always make a fund pay-in prior to your taking delivery. So this is always accepted. There is always a penalty on delivery default, and that penalty is equivalent to 3% of the final settlement price, which is announced by the exchange, plus the replacement cost. What is this replacement cost? The replacement cost is the difference between the settlement price and the spot price. That is the replacement cost. That means if I'm expecting, let's say, for example, 5 tons of soybean to be, delivered to me, there is a difference between the spot price and the final settlement price, which was announced about a day ago. That has actually been taken care by way of calculating this replacement cost, because that exactly assumes that if you are not getting the delivery of the commodity on the exchange, then you will have to go to the physical market to procure it. And if you have to go to the physical market to procure, there will be a different price between the final settlement price, which was announced a day or 2 days earlier, and that replacement cost will have to be borne by the defaulting party on the opposite side, because you as a seller who had failed to deliver that particular commodity. And the same is in the case of non-agri commodities. And the final settlement price is the settlement price which is announced at the time of expiry. And as Mr. Prasad told you, every day the spot prices are polled and then announced in the exchanges actually. And these spot prices, anchor the markets around what the spot prices and the spot trends are about. At the time of expiry, the exchanges take 3 days or 5 days of average of the spot prices as the prices for final settlement of the contract. Typically, they will be somewhere near to the prices which are prevailing in the spot markets. So this is how the convergence happens. So, and there may be some changes in expiry date because the underlying market is today not operational, or there is a bond in the place where you are supposed to deliver the commodity, and hence there may be possibility for default on the seller side and things like that. So these are being taken care in advance by moving the expiry date to an earlier date or mostly to a later point in time, and they will announce accordingly the settlement procedures for a later point in time as well actually. So this happened very rarely because all of those are being taken care by the exchanges in advance, determining the holidays and things like that actually. And one of the part which is important from a contract design perspective is the delivery center. Whether your delivery center is the center which market actually recognizes as the benchmark delivery center, and criteria for settlement mode, the location premium and discount. If there are 3 or 4 settlement centers are there, what should be the location premiums and discounts which will be applicable actually. And as I told you, the buyers are not supposed to default, and if the buyers are defaulting, then they will be put on a square off mode, and the commodity which has been paid against the buyer's obligation will be auctioned in the market, and the buyer will be subjected to further disciplinary action. The sellers may default provided they pay 3% of due date rate as their penalty, which is the final settlement price. And then the replacement cost is also paid. And that replacement cost is basically collected and partially given back to the buyer on the other side, because he's not getting the delivery of that commodity. A certain percentage is given back to the buyer on the the replacement cost is fully given to the buyer. A certain percentage of the DDR is given back, and the rest of the percentage is actually kept with the settlement guarantee fund as per the SEBI regulations actually. So, these are the factors which determines, how exchanges, fixes a particular delivery center, whether it is a benchmark center or not, what sort of liquidity which may be there, who are the value chain players who may be there, what is the infrastructure support that they have in the place where they are supposed to deliver and things like that actually, and what the trade feels that, the delivery center should be. And that is also being taken care of by the product design team, and the product advisory committee also takes that into consideration before giving an approval to a particular contract. So this is a scenario wherein if you don't have prices on the expiry day, then they can take E-1, E-2, and E-3 prices and calculate. And these are like, different scenarios under which the final settlement price can be calculated and announced by the exchange actually. And that final settlement price is based on the spot prices, which were calculated on the expiry day, before 1 day before, 2 days before, and those were averaged out, as I told you. So there is a polling mechanism which goes behind that, which is being done by the clearing corporation. There is a spot polling team that calls the people in the market, and they have set up participants who have registered themselves to be, price givers in a particular commodity, and they will be called on a regular basis at a particular time, and their, price call is being taken, and then, the extreme numbers are, booted out, and then an average of the prices which have been calculated is done, and then, announced in the market as the spot price. And these spot prices typically in most of the commodities are calculated, announced 2 times in a particular day. That is something you need to understand. So it's not, collected, calculated, and announced 1 day, 1 time in a day. It is announced in most of the commodities 2 times in a day. So that any movement in the prices that happens, maybe in the afternoon session or maybe in the evening session, is being taken care by a separate spot price that is coming into the market. And it also helps the exchanges in terms of monitoring the positions that are there in the spot markets actually. So this is the spot price polling process. The team calls the info vendors or the people who have agreed to give the spot prices, and those spot prices are computed. The average is computed, the outliers are booted out actually, and then the average is broadcasted through the terminal, the trader workstation, as the settlement price for the day. And the same, the spot price for the day. And the same spot price on E0, which is the expiry day, the day before expiry, which is E-1, and 2 days before expiry, which is E-2, is used for calculating the final settlement price to be announced on the expiry date, actually. And the empaneled polling participants who agree to give prices can be auctioneers, can be traders, can be cold store owners. If there are commodities like potato, which is coming out of cold storages, there will be farmers, there will be graders, the millers, the commission agents. So all types of value chain participants will be participating in the spot polling mechanism. And this is the mechanism, you can just go through it. These are part of the exchange contract specification, which you will be able to look through on the exchange terminal on specific commodities in terms of the contract specifications and things like that. And the important part, or the final part that is coming in, is your warehousing. So you don't complete the settlement cycle until you get the warehouse receipt in your name, and what you receive is actually in line with what has been assured by the the exchange. So the exchange in turn enables that this is being ensured by way of comprehensive framework that they have in terms of accreditation of the warehouses who can function as the delivery center on behalf of exchange, and they have to be WDRA accredited. That means they have to be compliant with WDRA norms, and exchanges also follow the Securities and Exchange Board of India and prescribe additional norms for guidelines for compliance, and once they meet the compliance, then they will be accepted as an accredited warehouse service provider or a WSP. And there are separate set of eligibility norms, which is in terms of financial norms, which is in terms of the governance norms, which the warehouse service provider will have to ensure. In terms of the financial norm, they will have to have a minimum capital net worth, which has been prescribed as per the specifications of the exchange for different commodities. And they will have to keep a security deposit of minimum 50 lakhs, and which will be at any point in time reflecting the value of the goods which may be there. Suppose in case you have about 2 crore worth of commodities, you should definitely keep about 70 lakhs the security deposit actually, which is 33 times 33% of the net worth of the this one. So it is also benchmarked to the value of the commodity which the exchange stakeholders or the exchange participants have stored in that particular commodity. So it can increase or decrease depending on the financial security deposits is 3 to 5% of the value of the goods which are stored. So it's automatically linked to the total value. If the total value of the goods stored increases, automatically the exchange will have to pay a higher financial, or the WSP will have to keep a higher financial security deposit. And he will have to be a fit and proper criteria. He may not have been punished for any economic offenses by the law and order enforcement mechanism, and they will have to have their own grievance mechanism or grievance settlement mechanism, and they will have to have a compliance officer at the same time as well. And in addition to these, there are separate set of norms which are announced by the Securities and Exchange Board of India in terms of how accreditation of affairs can be taken care of by the exchanges and the accredited WSPs, and the monitoring and inspection, how frequently the warehouses would have to be inspected, so that you've given a commodity 3 months in advance, and if he runs away with the commodity and that is his rented warehouse, and he runs away with the commodity, what is the assurance that you get it? So in order to prevent such kind of incidences which are arising out of the fidelity of the warehouse operator, there is a periodic inspection which is being done by the WSPs, the exchanges on the WSPs actually, to ensure that the commodity which is delivered, which is supposed to be maintained, which is actually reflected in the MIS system of the warehouse service provider, is there in the warehouse actually at the time of inspection. So there is a grievance cell which should also be done by each of the WSP who is providing services for the exchange, and he should have a business continuity plan, and there are certain set of actions which can be enabled by the exchanges if they don't meet any of those norms and things like that. And the status report of whatever that is being done on the exchange will also done on the warehouse will also have to be informed to the exchange, and even to the extent of the sampling mechanism and things like that is also being taken care by these norms actually. So on the one hand, your commodity is in the safe hands in terms of accredited warehouse service providers. The exchanges ensure that even if you don't get the commodity, you are compensated for the loss because you couldn't get that commodity. So that is where the trust comes in, that which is provided by the counterparty position, which is being taken by the clearing house of the exchange against each and every buy and sell position that you end up in the market and want to take or give delivery. So this is the way the exchange ensures that the clearing risks are managed. That's it. Thank you. If you have any questions, quickly I can answer.
Yes, sir. Thank you so much for sharing your immense knowledge and educating us in the area of clearing and settlement in commodity market. So we have some few questions. Ganga Devi ma'am will be asked. Over to you, ma'am.
Hello, am I audible? Hello.
Yes, Professor. Yeah.
Yes, sir. Yeah, sir. Thank you so much, sir, for sharing your rich experience in the clearing and settlement in commodity markets. And you have covered the topics like risk to derivative market, how to manage the different kind of risk in the markets. What is the risk management system? You elaborate in a very nicely and in a nice way. Clearing process for different participants, clearing mechanism also, settlement schedule and their mechanism, type of settlement, settlement process flow, and delivery process and their types. So many subtopics you have covered very nicely, and you have taken very extensively, sir. Thank you so much for that. I have some queries, sir. Sir, some of the participants want to ask that how the commodity volume is affected to future prices for the discovery. As in our case in spot market, if we see then what happened, supply and price relationship is there. When the supply is more, obviously the prices are low. So is there any kind of mechanism are there in our future markets, or any kind of relationship with the volume of the commodities? Hello. Hello. Sir, yeah.
Sorry. So again, so this is again linked to the question that was asked in the previous session, which is about the efficiency of the price discovery of the futures market. So if I have to answer it in few sentences, I would say that you are talking about a price for September 30th delivery for soybean, because the expiry day of the contract for September is September 30th, correct? So keeping that in mind, the players in the commodity derivative or the September contract for soybean will always look into what is today's spot price, what would be the carrying cost of that soybean. If I'm putting it on the warehouse and carrying it over for delivery in the end of September, and which includes your warehousing charges and the cost of funds and things like that. And then what will be the change that may be happening in the demand and supply situation, as a result of which the prices may be higher or lower or are lower. So all these factors today determines, sitting on, let's say, September 17th, determines what should be the price that you will receive for soybean on September 30th, actually. So there is nothing which will tell you that this is how the price discovery will have to happen, but it is that what is today's price, what is the carrying cost, and what is the expected demand and supply scenario on September 30th. So that is how the price discovery happens, and that is being allowed freely in the commodity derivative market. There is no control, and there are certain controls which is explained by my colleague, and I also tried to explain that there is a price circuit filter on any given day based on the historical movement of the prices. It cannot increase more than 4% or less than by 4%. So if it is 100 rupees yesterday, today it cannot go down below 96 rupees, it cannot go above 104%. So in the inaugural session, I told you that there are also commodities where the prices, after they have removed, the policymakers have removed it out of the commodity derivative markets, the prices become much more volatile than they were in the commodity derivative markets when they were getting traded, because they didn't have price circuit filters which control the price discovery mechanism in the market, actually. So price circuit filters also do control it. And if there is too much of volatility, the volatility is also managed by way of higher margin, which is charged. So these are ways by which exchanges manage the price discovery process. Hope I was able to explain.
Yeah, sir. Sure. Sir, another query is, you have discussed in one of the slide base minimal capital. So have to pay from both the parties and all kind of participants in the market.
Minimum, if you can repeat the question, madam, there is
base minimum capital, sir.
Yes.
So it's have to pay from all the participants, or if there means some kind of participants
the capital,
also.
Yes, madam. It is the capital which you have to keep it if you are a trading member or a trading clearing member, as per the Securities and Exchange Board of India norms announced by the exchanges actually. So every trading member will have to keep his minimum base minimum capital, and this base minimum capital also depends upon whether you are a trading member, whether you are a TCM or the trading cum clearing member, or whether you are a professional clearing member or an institutional clearing member. So depending upon how much of the monetary exposure or the financial exposure they would bring onto the exchange, and the exchange in turn ensures that they have enough amount of net worth. In case if there is a default which cannot be managed by the settlement guarantee fund, that can be managed by way of accessing the net worth that they have submitted actually. So that is the purpose behind net worth which is being imposed by the exchanges on the members of the exchange. If you are a retail participant, then you don't have to keep that actually. So that is kept by the members.
So, sir, the amount is fixed for all the participants, or it's
yes, it is fixed for trading members separately. It is fixed for trading and clearing members. I think it's about 10 lakhs, 50 lakhs, and I think it runs up to 1 crore rupees, depending on which type of member you are.
Okay, it's vary with the kind of the participations in the members.
Type of participant, amount of financial risk that you will bring to the exchange.
Okay, sir, another query is, if any default case is there, so penalty is imposed. So what about the amount of the penalty? How the penalty will decide for the any defaulter case?
So, which is what I told you. If I can, I just closed the PPT, but I told you the amount of penalty will be equivalent to 3% of the due date rate.
Okay.
Suppose in case 100 rupees is your due date rate, and that's the total value of the contract, not the due date rate. It is the total value of the contract, 3% of the total value of the contract based on the due date rate, and then the replacement cost. The replacement cost is nothing but the difference between the final settlement price and today's prevailing spot price. So they will, if there is any difference on the negative side, that the final settlement price is lower than today's spot price, then you will have to also pay the, the replacement cost. And that replacement cost is totally transferred over to the buyer on the other side because he couldn't get the delivery of the commodity. And the portion of the the 3% of the due date rate, which is calculated, which is collected by the exchange, is also given back to the grieving party on the other side, who's the buyer.
Okay, sir. Sir, one more query is that if the product is superior than the given specifications, then the premium is decided. So on what basis the premium is decided? Again, the same like penalty. Is there any criteria?
The premium is decided sure. The premium is decided based on, the premiums which are prevailing in the spot markets, actually. So that's again, I have my own critic as not as an ex-employee of the exchange, actually, but as my own critic is this premium is also a function of time. At any point in time, this premium can be X plus Y, X plus Z, X minus Y, or X minus Z, actually. So you don't know what that, but what exchanges do is they announce a premium depending on the quality or the location where you are trying to deliver. And that is fixed based on whatever the survey that they do in the physical market, and find out what the premiums are existing between different higher quality of the particular commodity compared with the exchange traded quality, and that is announced in the market. So it's based on the physical market served. That's it.
Okay, sir.
But it is fixed. But it is fixed. It doesn't change. In the spot market, it may change, but in the futures market, it doesn't change.
Yeah. Sir, one of the participants want to ask meaning of staggered delivery period. What do you mean by the staggered delivery period?
Staggered delivery
Yeah,
period, actually.
Yeah.
Staggered delivery period is something like, let's say, for example, let's take the same example of soybean, which is supposed to be delivered on 30th, and the contract by way of its design, due to some reasons that people market want to take delivery earlier to the delivery expiry day of the contract, the exchange can enable the delivery of the particular product 5 days before. Because there is not much of change in the spot prices, between the final settlement price that may happen and as of the day. So you will have to take that settlement price, which is announced on the staggered delivery day, and you will have to settle that contract, and you will have to find out the matching buyer and the seller. So if the buyer is willing to take the delivery and the seller is willing to give the delivery, then the positions are matched during the staggered delivery period, though the expiry period has not arrived at, actually. So that is being enabled to ensure that there is a continuous delivery that can happen even before the the final settlement of the contract happens by way of expiry day and expiry time settlement. So that enables that the contract keeps on reflecting the spot market prices.
Okay,
That's
sir.
it. And only few contracts have that staggered delivery period. So this delivery period may be between 5 to 10 days before the expiry date of the contract, depending on which contract you are looking at.
Okay. Thanks a lot, sir. That's it, sir. Thank you so much, sir, for sharing your rich expertise in this subject and to deliver all the things which related to our subjects. So thanks once again. Thank you so much, sir, for joining us with. It's our pleasure to listen to you. So again, very thanks a lot. Thank you so much.
Thank you, madam. Thank you.
Over to you, sir.
Thank you so much, sir. The session was so informative and alive. I would like to say that tomorrow's technical session will be started at the morning 10 o'clock. The topic will be commodity options, pricing basis, and commodity indices, which will be delivered by Mr. Abhishek Rajulkar. I request all the participants to join the second day technical session 1 at 10 o'clock. Thank you.